Okay, welcome. We're going to call the public hearing to order today, Tuesday, March 5th. The Banking Committee. We have 10 bills on our agenda today. We have 17 speakers, so look forward to an opportunity to hear from everyone. I'd like to ask my ranking member, Rep. Delnicki, if he'd like to start with any comments.
Good afternoon. It should be an interesting public hearing here. I know we're touching on a number of interesting topics pertaining to crypto and things of that nature. And that is always like the new frontier. So I'm looking forward to today's public hearing and the testimony that we receive. Thank you, Mr. Chair.
Thanks, Rep. Delnicki. Okay, so with that, we will go ahead and get into it. First on our list today is the Senate Majority Leader, Senator Bob Duff, right on cue. Welcome, Senator.
Good afternoon. This brings me to my old haunts. I used to be in this room a lot for appropriations. Feels a little like PTSD here of that, but hopefully to your point, Representative Delnicki, hopefully my bill will be the most boring bill you hear today, which will garner the most support. I hope. So I appreciate your allowing me to come on first and being able to testify in strong support of Senate Bill 284. So thank you, Mr. Chair, Representative Delnicki, Representative Santos. I appreciate it. The availability and affordability of housing is perhaps the most important issue of this decade. Housing provides security and stability. Without it, students face greater difficulty focusing in school. Families will be more susceptible to illness, and children will never know true safety. One of the barriers of accessing housing for many Connecticut residents is the requirement of paying a security deposit before renting a residential property. We have residents who, despite working multiple jobs and living simply, are living paycheck to paycheck. These residents do not have the funds to pay both first month's rent and a security deposit, which is usually the equivalent of 1 or 2 months' rent. This can lead residents to taking out high interest loans to pay these security deposits, which then increases the individual's amount of debt and exacerbates their fiscal problems, increasing the possibility that they won't be able to pay their rent and will be evicted. This bill allows some of our most vulnerable residents, including low-income households, recent college graduates, victims of domestic abuse, and veterans to receive a loan from an eligible financial institution for a security deposit equal to 1 month's rent, but an interest rate capped at 4% per year. The renter has 24 months to pay the loan back, and if they fail to do so, upon submission of the claim, the state will pay the loan provider 25% of the outstanding loan principal, and the loan will be assigned to the state. This bill works in tandem with Senate Bill 6, which I just testified on a few moments ago, which addresses the accessibility and affordability of housing. Together, these bills will ensure that Connecticut residents have a roof over their heads, and I urge you to please support this highly important bill. And last, I just want to mention that this is also, I just want to give Senator Maroney a shout out on this because this is really something that he's been working on. I'm really here in his absence because it may know he's had a death in the family. And so I wanted to make sure on the record that I supported something that he's worked on and certainly talked to Senator Miller about it as well. But happy to take any questions if you have any.
Thank you, Senator. I was going to mention that as well, that I know it's been a tough week for the Senate with Senator Maroney's father passing away. And certainly I extend, and I know we all extend our condolences and thank you for to picking up the mantle on this. This is a very innovative concept and one that he did quite a bit of work on getting it into shape and working, I know, at least with one bank in the community that is very interested in this and offered a lot of substantive comments. So it's a very interesting concept and certainly want to credit him and credit you for supporting it, and we'll see where it goes. Any other questions for Senator? No?
Thank you very much.
All right, thank you, Senator. Next we have Senator Martin. I do not see him here, so we will skip Senator Martin for now. After that, I have Matt Smith from the Department of Banking on our list. Afternoon, Matt.
Good afternoon. How's everybody today?
That's fine.
Thank you, thank you all for having us. I have 3 bills that have caught the attention of the department. 2 are agency proposals. I'm going to, for now, limit my testimony to 2 bills. The bill on consumer credit, I would happy to entertain questions. It's a very technical bill. And happy to offer some more testimony on it after, but for my first 3 minutes, we'll go with the virtual currency bill and the security deposit loan assistance program. Chair Doucette, Ranking Member Delnicki, my name is Matt Smith. I'm the Director of Government Relations and Consumer Affairs here at the Department of Banking. I'm here to offer testimony in support of House Bill 5211, an act concerning virtual currency and money transmission. This bill is designed to expand protections for consumers who use virtual currency kiosks. A brief summary follows. In Section 1, we expand the definition of cash as a permissible investment beyond stating just U.S. currency. For example, this would include cash that's in transit, such as in a wire transfer, savings deposits held by licensees, cash held in smart safes, cash held in locations owned by licensees, among other options. This language is consistent with our money transmission law. Section 2 requires virtual currency kiosks operators to be licensed as money transmitters, making them subject to the money transmission laws of the state. Section 3 adds a requirement for licensees to have a detailed wind down plan. Section 4 sets a maximum fee of 10% per transaction allowed for virtual currency kiosks and removes the foreign wallet requirement from the refund clause. Section 5 introduces a new section to add a receipt requirement for the provision of receipts to customers for each money transmission transaction. Receipt information should include, as applicable, the name of the sender, the name of the designated recipient, the date of the transaction, the unique transaction identification number, the name of the licensee, the amount of the transaction in United States dollars, and any fees charged by the licensee, among others. We look forward to working with the committee and other stakeholders as the bill moves through the legislative process. Happy to answer any questions on this bill. Accompanying me today is Detective Matt Hogan from the State Police. He works on these issues and is happy to answer any questions on this particular bill. The second bill, Senate Bill 284, an act concerning a security deposit loan assistance program. The department supports the goal of the bill to help renters overcome a significant barrier to housing. However, there are several aspects of the bill that merit further consideration. The primary function of federal and state banking regulators is to ensure the safety and soundness of financial institutions. Requiring banks to provide credit without considering how this may impact their ability to operate in the future is not something we or any regulator can enforce. Therefore, we would respectfully request that 100% guarantee be provided to these loans, or they become subject to normal or slightly modified underwriting standards. A modification might include varying credit scores. We can all agree that financial institutions should not extend loans to those who do not have the capacity to pay it back. The bill also does not consider how current laws governing rental security deposits may impact this program. For example, there is no provision on what happens at the termination of tenancy. Under current law, to receive a return of a security deposit, a tenant must provide a forwarding address. The landlord then has 21 days to either return the deposit to the tenant or furnish the tenant with a list of itemized damages. If the tenant fails to provide a forwarding address, the landlord keeps the security deposit. Therefore, if the tenant then defaults on the loan, the bank is entitled to only 25% of the principal of the loan. The bill also requires the Department of Banking to provide financial literacy to program participants. Currently, the department lacks the resources to fulfill this obligation. We would require additional appropriations to launch and maintain such an initiative, either through increased staff and resources or the hiring of a third-party vendor to fulfill the function. The bill also requires the department to, quote, make enrollment and participation in service to report on-time rental payments to credit bureaus available to an eligible renter who receives a security deposit loan pursuant to this subsection. Considering the financial institution is the entity extending the loan and the Department of Banking would not have access to the renter's on-time payment data, it would be more appropriate for this provision to sit with the financial institution making the loan. As written, there is also a potential conflict with the regulatory responsibilities of the department, since we enforce provisions of the Fair Credit Reporting Act. The bill also requires an application fee of $50 to defray the cost of credit reporting. For reasons enumerated above, the application fee should be paid to the financial institution extending the loan. In addition, the proponents of the bill may want to consider lowering this fee to $25, which should cover the cost for credit reporting. Department is, as always, happy to work with the proponents of the bill as it moves through the legislative process. Happy to answer your other questions. If you'd like some information on Bill 187, I can provide that as well.
Thank you, Matt. First, Lieutenant Hogan, thank you for joining us today. We have you on our list to testify later, and I'm sure we also have questions for you specific to the bill and specific to your role. Did you have other testimony that you wanted to offer? And if so, I'd have you come back once we get down to the end of the list.
So I was instructed to come at this point, and so you can kind of negate me off number 6.
Okay.
But for that aspect, I am here obviously to support measures in the bill.
Okay.
I do want obviously any kind of measures that will assist in cryptocurrency ATMs, helping us work on the
Okay.
investigative trail. So whatever we can do to help.
All
the
right, so I'm
process.
sure we'll have some questions for you on that. Before we get into that, though, Matt, I did want you to, if you could, just for the benefit of those who are here and watching elsewhere, if you could summarize briefly the provisions of Senate Bill 187.
Absolutely. Didn't want to overstep my time limit here. So this is a largely technical bill and kind of gets into the weeds and some of the stuff that the department does. Sections 1 through 5 requires bond cancellations to be done electronically. If you recall last year, I think it was last session, we made a requirement that they file bonds electronically. Now we're requiring them to cancel them electronically as well. Sections 6 through 11 removes existing requirements that mortgage, money transmitter, debt adjusters, debt negotiators, mortgage servicer, and consumer collection agency licensees update their surety bonds when they change their location, since the new electronic bonds on the nationwide multi-state licensing system and registry do not reflect address locations. Section 12 clarifies that receipt of any payment on a retail finance installment contract constitutes activity requiring licensure. Sections 13 through 14 creates a new registration type called an exempt mortgage servicer registrant for mortgage lenders who also service mortgages. Currently, mortgage lenders are exempt from having a mortgage servicing license. Mortgage lenders who engage in servicing activity are required to hold multiple bonds. The NMLS is the system that we use to sort of manage all of these, only allows for the listing of one bond type. Since the surety bonds are now electronic, this new license type will allow us to capture bonds for these companies by requiring mortgage lenders who also service mortgage loans to also register as an exempt mortgage servicer registrant, allowing for the acceptance of a mortgage servicer surety bond. The new registration type is necessary for implementing electronic bonds on the system for these entities. Section 15 places obligations concerning cosigner releases on private education lenders and private education loan creditors that currently apply only to servicers. This is aimed at reducing confusion among servicers and borrowers and guaranteeing cosigner releases when criteria are met. Section 16 extends the commissioner's right to suspend, revoke, or refuse to renew licenses to apply also to registrants. This authority already exists with the entities that we license, through the Consumer Credit Division. It also extends the same rights and protections of licensees to registrants. Section 17 clarifies that receipt of any payment on small loans constitute activity requiring licensure. Section 18 does the same for payment on mortgage loans. And Section 19 does the same on student loan, private student loans as well. Section 20 is a conforming change to current departmental practices. Specifically, it aligns registration renewal timelines with existing timelines for licensees. The renewal period opens on November 1st and closes on December 31st. Thank you.
Thank you. Appreciate it. There's a lot in there. So
Yes,
just wanted
it's,
to make sure that we had an opportunity to get into that. And if anyone had any questions on anything in there. Okay.
Excellent.
Why don't we shift over to 5211 since we have Lieutenant Hogan here as well. I do suspect there'll be some questions. One initially, Matt, is Section 2 essentially requires all persons engaged in the business of money transmission to be licensed as money transmitters. Although I was under the impression that certainly what bill we had last year addressed that, if not, the requirement existed prior to that. Is this change a supplementing that
Yes.
existing law, or is this a totally new change to
So
our money transmitter law?
the way last year's, excuse me, I'm sorry, I didn't mean to interrupt. The way last year's law was written, the licensure was only required if it triggered our money transmission statute, which is when a third party facilitates movement of money between two other parties. This bill requires that no matter what business you're engaged in, if you have a virtual currency kiosk, then you are required to have a money transmission license here in the state. And that's as you probably are aware, the money transmission laws have very strict BSA and AML, Bank Secrecy Act and anti-money laundering laws that apply to them, compliance regimes. So we feel like that having those in place are additional safeguards for consumers.
Okay, good. Lieutenant Hogan, while we have you here, we obviously had you last year as we considered the legislation, which was pretty significant at that time, and that we didn't really have a lot of those guardrails on the activity. And we heard a lot of the reports of fraudulent activity and the things that your unit was doing. Have you seen any change in that? And specifically, what have you seen as the impact of the new law?
So first I want to say thank you for putting on the record that you gave me a promotion. I'm just a detective, so.
Sorry.
It's okay. But we did notice a decline. So originally there were about 576 kiosks in the state and it dropped down to around 320 and change after the bill. And I think a lot of that had to do obviously with putting more stringent regulations on them. So we did see obviously that part of it decline, but as far as crime went, we still noticed scam volume typically around the same. It obviously changed varying on the type of scam typology scams. So you'd have the pig butchering scams that weren't related to kiosks, but then we would have the typical pop-up window scams that we did see more frequently. So initially we didn't notice much change as far as scams, but right now we are seeing slight decline in that.
The dollar volume is still significant, or?
When it comes to the kiosks, it's difficult because they have to have that threshold dollar limit, which I think is super important. When it comes to the more advanced like investment scams, they're obviously allowed to push more money through exchanges. So having the guardrails of the dollar amount is critical because a lot of times we feel like this is the easier method for older adults. They can walk into an ATM or to a consumer place and throw a couple dollars into a machine and transmit that way. Whereas the process of getting involved in an exchange is a little more detailed. So I feel like they're not as computer savvy typically. So these are much easier. We get a text message, with the QR code, you can go scan it real quickly. It's very simple. So.
Thank you. Other questions? Rep. Delnicki.
Thank you, Chairman. And a couple of follow-ups pertaining to the activity that you've had on law enforcement here. In your testimony, about $3.8 million has been recovered. And how was that recovery done? Because I know one of the some testimony that will probably be coming up later actually talks about it's not possible to reverse a transaction.
to is 10 point. So usually at the point where it's exchanged, that's one of the United States.
And you also, just, and I'm going to quote from your testimony, just days ago, an unlicensed kiosk, Cash 2 Bitcoin. And there was a $20,000 scam perpetrated on a senior citizen. Is that true?
Correct, yeah. What we were told by the local PD was it was a kiosk scam. They received the pop-up window type thing, and they went to one of the kiosks that's not currently regulated and transmitted $19,500, I believe it was.
So that speaks volumes to what we're talking about when it comes legislatively from state banking. Because do you, in your opinion, does the actions from state banking that they've requested here in the bill, does that provide some additional solid safeguards to actually protect seniors and to be able to return monies to those folks that are actually swindled?
I do. There are a bunch of stakeholders that we've spoken to throughout the process of working on this that have been very helpful. So it's not all operators that are acting like this. It's the small few. So the ones that want to be regulated are being very helpful. And I think that the ones that some of the measures we put in there, I think really will put some guardrails in place. I mean, for example, I think that having too low of a threshold on the percentage that for fees, because fees is always a big question about these. If we put the fee too low, the good companies that want to be regulated are going to leave. And you're going to be left with the companies like Cash to Bitcoin who chose not to follow the rules and are going around them. And then on top of it, I think some of the other things that were important were the details on the receipts that are printed out. Because some of these kiosk operators don't put all the details. They may put some ubiquitous like identifier, which creates a lag time for us to contact them, and we have to wait for them to respond to us. Whereas if the receipt had the proper information on it from the get-go, we can start the process a lot faster. So again, on some of the operators that we are dealing with do that already, which has been helpful, but some are not doing that.
And I noticed that was an unlicensed kiosk that was part of that whole scam there.
Correct.
How big of an issue is it in tracking down the unlicensed scams and the unlicensed Bitcoin ATMs?
You and the mayor.
Not really sure. I can get back to you on that. I'd have to go back to the department and see what we've sort of unearthed in the last year. But as we pointed out for section 2 of the bill, it does put more stringent licensure requirements on the virtual kiosks, the virtual currency kiosks. But I can get back to you on what we've sort of had to deal with over the past year, if anything.
And we received some testimony pertaining to the inability of some of these kiosks to actually carry out the refunding and things of that nature, and having an account and a variety of other things. In your opinion, when it comes to 5211, is everything possible to be done by these folks that operate the kiosks? Is everything in that bill possible?
To my knowledge, I know that there is an issue with the refunding of the transaction. And I think the department is open to some more conversations with industry and other stakeholders, particularly with the police, on what that might look like. But in some respects, if there is a scenario where the scam was perpetrated because the company did not have the proper safeguards in place, then we would look for the company to do some of that reimbursement to the consumer, which is why they're also required to have a surety bond.
Because I read through the bill and I saw that there was significant protections in there. And I read through the testimony of one of the folks that actually has the ATMs, and it basically was that you couldn't do these things, a number of them that you had enumerated there. And that's the only reason why I raised that issue, because what you purported there makes all the sense in the world. And if it can be done, it should be done. But if it can't be done, we need to know that upfront.
Okay.
Just to drift off to another bill. And if you have no opinion on this, I'll be more than happy to accept that. And that's Senate Bill 282.
282, remind me which one that is again?
That's the one, an act concerning the banking commissioner's approval of certain bank real estate improvements.
Oh, yeah, of course. So, we are in support of the bill. We worked with the Connecticut Bankers Association on that bill, specifically, inserting language that if, a bank, has a regulatory notice against them or some sort of filing or, enforcement action, then the provisions of expanding, the branch, they would have to seek approval, from the commissioner.
And I know we were talking about the down payment issue, that bill. So you made a statement that it would require a third-party vendor for the financial literacy aspect.
That would be, basically, we would approach that with the financial literacy, either hiring somebody in the department of which we would need additional appropriations for, or if, we may be able to find a third party that can do it cheaper, so that would require less appropriations. But those would be, things to consider, if the bill should pass and then we needed to implement it.
Yeah, and I asked that question based on the fact that you stated something to the effect of needing a couple of new people in there and a third-party vendor. And I just want to get
It would be
good feel for
or,
that.
I don't think we would.
Either or.
Either, it would more likely be an either or situation, not, probably not both.
Okay. Thank you for your commentary and thank
You're
you,
very
Trooper.
welcome.
Or is it Trooper or is it Detective?
Detective.
Okay, thank you, Detective.
Thank you.
Thank you, Mr. Chair.
Thanks, Rep. Delnicki. Any other questions? Anyone? Our members way down there. Okay, seeing none. Thank you, gentlemen.
Thank
Appreciate
you.
your
Always a
time.
pleasure.
Okay, next on our list, James Kenyon from CHFA. Good afternoon.
Good afternoon. Representative Doucette, Representative Delnicki, Representative Santos, and other members of the committee. I'm Jim Kenyon. I'm a senior counsel at the Connecticut Housing Finance Authority. I'm here on behalf of Nanthanin Natarajan, who's actually in Washington, D.C., meeting with our congressional delegation there. Thank you for the opportunity to submit testimony today concerning Raise Bill number 283, concerning programs administered by the Connecticut Housing Finance Authority. Thank you very much for your support of in particular sections 1 to 6 of the bill. This relates to the Emergency Mortgage Assistance Program, otherwise known as EMAP. CHFA has administered EMAP for over 30 years, dating back to the 1990s. It's a program funded with state dollars to help homeowners who avoid the loss of their homes, which might otherwise occur due to foreclosure of their mortgages, tax liens, or condo assessments. CHFA has administered on behalf of the state the $123 million Homeowner Assistance Fund, which we administered under the name of My Home CT. Learning the lessons from that experience, we very much support the proposed changes to the EMAP statute. A key aspect of this legislation is we're not requesting any additional funds. We believe that the language would actually, in the statute, would actually enable us to expand the eligibility for homeowners when the time comes for when they need the assistance. And then also it would provide additional flexibility to us to enable us to, for example, defer repayment of the EMAP loans. Presently, homeowners can qualify for up to 60 months of assistance. And after that time period, once their income is of such a level that their housing expense ratio is 35% or less, then they would commence repayment. Because a lot of people have struggled to meet that 35% housing expense ratio, most of the folks are in deferment status now. So that one change would actually enable us to grant deferment to all homeowners who receive assistance. The primary source of repayment of the EMAP funds is through the sale or refinance of their mortgage loans. So once homeowners who've received assistance get it back on their feet, many times, some point down the road, they become more financially stable and they either sell and purchase another home or they refinance. And that's what provides us with the ability to, that provides us with the funds back. We are looking for an additional, there is an additional safeguard in the bill. We would look for the discretion to establish a cap on the amount of assistance on the My Home CT program, which I spoke about. We had a $50,000 per homeowner cap, which proved to be very helpful in us in allocating funds. I did want to make one observation on Section 7 in the bill. Section 7 relates to our multifamily projects. It would require developers of multifamily projects who receive state or federal funding administered by CHFA to provide funding to hire an advocate to represent the residents of a project which is being rehabilitated or revitalized. We recognize the importance of there being efforts to protect residents in multifamily dwellings. We have a concern because such a requirement in the statute could result in there being additional costs that developers have to pay. And in many, if not most of our multifamily developments, there's always a gap. And so this might unintentionally create an additional gap. And the present gap filler for many of our developments is the state of Connecticut, either through the Department of Housing or through DECD. So we have a concern about it going into the statute as a requirement. We have undertaken steps in terms of making our guidelines more robust in the past year. So now we require at least 2 meetings with tenants concerning issues of tenants, such as relocation and what their housing would be while there's a rehabilitation going on. So I think we would look to work with the committee in order to have a dialogue about what would work best to meet the objectives without having actually a per se statutory requirement. Thank you, and I'm happy to answer any questions you may have.
Thank you. Appreciate you being here. Picking up where you just were on that Section 7, you described the gap in funding. Would that not be funds that the borrower would have to provide within their budget? I guess I'm struggling to understand how significant a gap that could really be, and that there wouldn't be any other available funds from the borrower's own funds to help bridge that gap.
Right. That's an excellent question. Typically, when we in our multifamily unit, when we get in applications, borrowers, the developers typically establish single purpose entities. And they come up with a source of funds, and they come up with a development budget with various sources and uses. And so, and those uses could include even, there's the construction contract, then there's the architect's fees, legal fees, and the relocation expenses, for example. Then when the sources, typically CHFA, for our multifamily developments, we finance projects with bonds, and the bonds have to be repaid. So and when it's a property which is financed with tax exempt bonds, then we're able to offer a lower interest rate. Then most often, or very frequently, there are gap funds from the Department of Housing which are a source. Now, so the borrower doesn't necessarily have any additional source of funds, but there are sources of funds that do come into play, such as net operating income that might be available during the course of operations, and those are taken into account. And then oftentimes developers are separate from the borrowers, and they get a developer fee for doing the orchestrating it all. And so many times they defer a portion of the development fee. So, those are considered sources that are help us balance the budget.
Right. And I guess
Yeah.
that was my point. I said borrower, perhaps I should have said
Right, right.
developer.
Yep.
That, that could be either separated out from what's listed as a developer fee in the budget or somehow absorbed within that cost. At the end of the day, the same place, the onus would be on the developer to fund it. And again, I'm not sure how significant a fee that would be and what the likely cost of that item would be.
Yeah, and actually, we have a little bit of a concern because it's not, the language in the statute is not in depth about how much, what level of funding would be required. And there's a reference to an advocate and whether this advocate would be a person that might have to be engaged for, let's say, a 2-year period, because many times a rehabilitation might take 2 years. So we have a concern about how broadly that might be construed. And so it may be that, our desire, I think, would be to give us the leeway to require these sorts of things and push developers to do it, but not necessarily specify by statute that it has to be done. We don't know at this point what the cost would be.
Right. Okay.
Mm.
Shifting gears a little bit, on one aspect, you ran through some of the changes in the EMAP program that are in here, and you may have mentioned it, but there were quite a few in there. Specifically, the change from 60 to 30 days, that the homeowner be a delinquent for 30 days or more instead of the current 60 days. Could you talk a little bit about that and why you think that is a necessary change?
Well, we were looking to make, we had suggested changes for, proposed changes for this legislation, which the committee has moved on. And the feeling was that if we expand it, then that might help homeowners who know they're delinquent. Maybe they lost a job and they know they're going to have a continuing delinquency, proceed to request EMAP funds. We have a duty to process applications within 30 days. So if someone were 30 days delinquent and then they got their application in, let's say on day 35, which would be optimistic, and we process it after day 65 of delinquency, then we have effectively stopped the bleeding at that point earlier in the game. We recognize there may be some concerns, and so leaving it as a 60-day period would certainly be fine by us. We're administering these funds on behalf of the state. It's not our money. We're looking to do what's best for all interested parties.
Yeah. So I don't know if you saw the Connecticut Bankers Association submitted testimony, and that was one of their concerns there, and particularly that it might increase demand on the program. And do you find that is, I mean, I don't know how close you get to sort of exhausting funds, or whether or not there's any concern internally that creating additional demand would push you to a point where you couldn't accommodate or help more homeowners who may have more prolonged delinquencies.
Right. Well, I don't think we would have any objections to leaving it at 60 days if that's not an issue at all. And I don't think that reducing it to 30 days would result in an undue depletion of the resources we have. So we would be fine with leaving it at 60 days. In some respects, many times people will not to minimize the stress that folks are under when they do experience a financial hardship, but many times when they look around and they're at the 30-day time period, maybe they do find those funds from some source and they come up with it, or they get reemployed, for example, within that time period. And so that they ultimately realize they don't necessarily have the need for assistance.
Yeah. Okay. Any other questions? No? See any? Okay.
Great. Thank
That's
you
it.
very much.
Thank you, sir. Appreciate you joining us today. Okay. Oh, just pointed out to me that Senator Martin is here. Senator, we skipped over you a few minutes ago. So we'll invite you up now. Thanks for joining us.
Thank you. Whoa, I feel like I'm in the, here we go. Thank you. I see that Senator Miller is not here. It's understandable, but Chairman Doucette and ranking members Berthel and Delnicki and other members of the committee here. So I'm here to speak about SB 188. It's requiring Connecticut banks to list all account holders on bank statements or periodic statements. As you know, the elder financial abuse is a large problem in not only in our state, but throughout the country. And I know that we've taken measures to protect them. And I think hopefully this bill, you will recognize that maybe we can do a little bit more. But I was approached by a constituent last year regarding something that happened within their family. And I'm here to ask you that I'm here to ask that we provide a statute that would clearly allow or provide the names of all the members or individuals that are on the account to be clearly seen on the envelope or through the window of the envelope. This would allow anyone who is helping the elderly know who is on the accounts. And I'll just give you a little background as to what happened to my constituent. Dad, in 2011, Dad takes a fall. Brothers started to help with the groceries and transportation needs. Mom had taken care of all the finances. Dad was the bread earner. Mom paid all the bills. So mom passes away and the boys start to help with the finances. And to learn that the sister was granted a power of attorney almost 6 years prior, 1995. But the thing was the sister, I believe, lived out in Arizona now. At the time when the POA provided, she lived locally, but now she was living in Arizona. In 2012, they saw, now again, the brothers are handling the finances, and they see on the statement DOT, which meant transferable on death. Dad didn't know what that was. Once the brothers asked. So Dad in 2016 takes another fall, and they decide that, a new POA needs to be administered. So when they start to go to the banks to transfer to make that change, they're not authorized because the name on the account wasn't Dad's anymore. It was in the sister's name. So the sister got confronted by it, but the harm was already done. The account names were changed to the sisters, and all the major funds were now in the sisters' hands. And I don't know the whole story to the story, but from what I understand, those funds were not in Dad's possession anymore, and whether or not they were spent or Dad passes away and now those funds, they were counting on the sister, or one of the brothers was counting on the sister to disperse the funds as the dad wishes, but that was not the case. So that's sort of a very quick summary of the story, but the ask is really to just help families recognize, who is on the account. Dad didn't even know about the DOT. The 1995 POA was granted, but now they were looking to change it. And unfortunately, it was an abuse case. So.
All right. Well, thank you, Senator. Thanks for bringing this back to us. As you know, we also heard it last year.
Right, yeah.
And at that time, we had a pretty comprehensive bill that was negotiated between a lot of different parties, the lending institutions, the Department of Banking, AARP was involved. And we had this proposal as well in the midst of all of that. So it was sort of timely in that respect, but this specific proposal didn't make it into that bill. I would like to think, as you pointed out, that as a result of that bill last year, there are some additional protections that, like the scenario that you just gave, that somebody could avail themselves of, potentially questioning certain transactions. There was a provision in there too, after the fact, if it ever becomes litigated or it goes into probate court or something like that, that the burden of proof to show that there may have been undue influence has been changed, so it's easier after the fact. Of course, that doesn't help anything that happens in the meantime. So this is something I think we're constantly going to have to certainly keep our eye on. And I appreciate you bringing it back to us this year.
Thank you. Could I add, apparently there's a box to be checked off whether or not that second individual or whoever if it's an entity or whatever, on the documents that you need to file to take care of with the bank. If you check that off, then the name is not revealed on the envelope or in the window. So it seems like perhaps a really good fix that we could do, but I'll let you guys decide that. And thank you, Representative Set, for sending that email, let me know that the testimony that this got a hearing. I will let the constituent know that for him to send a new testimony to update it. Okay.
Good. Any other questions for Senator? Rep. Delnicki.
Thank you, Mr. Chair, and it's great to see you there, Senator. Question pertaining, you made a comment about the window on the statement and the possibility of having all the names that are on the account there. Logistically, would that actually work?
I do not know, depending on what font size, length of name. I don't know.
And I'm just thinking out loud, and I almost wonder if everyone on the account were at least to receive notification once a year, that might be a solution. Perhaps.
I think just letting other people know or family members know that, this is what dad is doing. This is what's on the account. I think just makes life simple for all the family members.
Yeah, because that might solve that problem if they were notified once a year that, all the different folks that were on the account.
Correct.
At least everyone would know at that point. That's just a thought.
Yeah.
Well, thank you for coming forward.
Having that POA grants considerable amount of power for one individual. And I don't need to tell you guys that, but okay. Thank you.
Well, thank you for coming forward. Thank you, Mr. Chair.
Thanks, Senator. Okay. I'm going to go back to Connecticut Bankers Association, Tom Mongello and Art Corey are on my list. You're back to back today, gentlemen, so. Correct.
Good afternoon, Mr. Chairman.
Good afternoon.
Mr. Ranking Member, Mr. Vice Chairman. It's great to see everybody in person at the Banking Committee. And hello to everybody who is also joining us remotely. So we're going to skip around a little bit today, if that's okay. We have 7 pieces of written testimony that we provided to the committee, which hopefully you have before you. We actually made paper copies for Senator Berthel, and I think Hannah's got them. Thank you, Madam Clerk. At any rate, I'll start off with, actually, I'm going to go to our bill, the Connecticut Bankers Association sponsored bill, and thank you very much for raising it here in the committee. I think as you heard from Matt Smith, we have come to an agreement, and you folks have the language on that before you that's in the committee with regards to this. I'm not going to talk a lot about it because you're going to hear from Mike Alberts, who is the CEO and president of Jewett City Savings Bank. on this in more detail. And yeah, I'm sure he'll be able to do a much better job answering the questions than I will. But at any rate, it's a good bill. It ought to pass. And we're obviously looking for your support on number 3, which is Senate Bill 282. Next up, I just wanted to briefly cover the EMAP program. As you heard from Mr. Kenyon, we've worked together for years on the EMAP program. We were there when it was first created 30 years ago, working with this committee and also the Housing Committee and CHFA. So we continue to work with them on it. It's a great program. It's good to see, quite frankly, that what I call the modernization of this. They've got a lot of experience as to what different conditions that people have coming forward. I think it'll streamline the whole program, give them more flexibility to essentially get those dollars out there to borrowers that need it. So we're supportive of that. And obviously, we're, as you see from our testimony, if we can keep it at the 60-day, that would be much more beneficial, we believe, because there's so many times where a borrower will get a 30-day delinquency notice and immediately pay it. I would venture to say it's probably close to 94, 95% of the time, you've got borrowers that either it got lost in the mail, it's a forgotten payment, or something happened. So they quickly rectify it, and it's only a very small number that actually go to a 60-day delinquency, which is why obviously we think that's the more appropriate time frame. So with that, that's it on that. Did you want me to take any questions on that in case anybody had any, or move on? Thank you. I'm going to turn it over to Mr. Corey at this point to talk about a couple of bills as well.
Thank you, Chairman. Thank you, Chairman Doucette, Representative Delnicki, Ranking Member Delnicki, members of the committee. Just a few other bills that we submitted written testimony we wanted to comment on. Senate Bill 188, the periodic statement bill that you just heard from Senator Martin on. Our testimony is very similar to last year. We understand from talking to many bankers last year and this year that especially when it comes to payable on death beneficiaries, account owners usually don't necessarily want those individuals to be seen on statements or in the envelope because it's a private estate planning issue for them. So that's a big concern for them. And if we did do that, we'd have lots of folks complaining about that. We understand completely the goal that's trying to be achieved. It's just, it may be counterproductive in the sense of customers' viewpoints on that. Another bill, Senate Bill 284, the Security Deposit Loan Assistance Program, very laudable goals there. We've submitted very brief testimony. There are it's a complex program that would be stood up by that bill, and we look forward to working with the proponents, the committee, on crafting something that will achieve what we think are, again, very laudable goals. The last two, House Bill 5345, the Mobile Manufactured Homes Bill, we think this is a great step in the right direction to helping incentivizing lenders, taking risks out of the way of mobile home lending, and we applaud the committee for raising that concept. Finally, House Bill 5342, an act concerning mortgage foreclosures. We spent a lot of time yesterday and today talking to our banks and many of their in-house lawyers about this bill. While it seems a fairly simple approach, we are concerned that there may be unintended consequences by the 6-year statute of limitations that it would establish for bringing foreclosure actions, which I believe, by the way, would apply to both residential and commercial, if I'm reading that correctly. But while we understand and appreciate the concerns that the 6-year statute of limitations is trying to address, and in particular with regard to second mortgage loans that become "quote unquote" zombie loans, those are loans that are bought by debt buyers, mortgage loans that are bought by debt buyers, and then perhaps not foreclosed on for years. So they're just kind of hanging around out there, hence the term zombie. But that's a very narrow issue, which we suspect happens somewhat rarely in Connecticut. Yet the statute or the bill is drafted very, very broadly. It would apply, I think, to every foreclosure situation, and including when a mortgage loan is still held by the originating financial institution. And in that case, we think that's where the unintended consequences could come in. Now, as I mentioned, we have had lots of conversations with our banks and their lawyers, and they've identified a laundry list, I would say, of questions and concerns about this, ranging from You know, the overlay of federal law, including you know, laws and rules promulgated by the Housing and Urban Development Agency, HUD, with regard to reverse mortgages. One of our banks identified that this law is potentially having a problem, causing a problem there, but as well as, you know, with Connecticut statutory and case law that's very complex and longstanding on foreclosures. And the overlay also with the Ezekiel Santiago mortgage foreclosure mediation program and the rules there. You know, what happens if a foreclosure is paused? Does that somehow have a negative impact on the 6-year statute of limitations and the ability to bring a foreclosure action? So, long way of saying, we've identified lots of questions and possible concerns with this bill that could, we think, create some fairly significant and maybe others not so significant unintended consequences. So still reviewing, look forward to, you know, working with the committee. Again, we understand and appreciate the goal with respect to addressing zombie loans. Thank you.
Thank you, gentlemen. Any questions for Art and Tom? Anything?
I did have, if it's okay with the chairman, I did have one more bill I'd like to talk about, if that's okay.
Sure.
Thank you. So I should mention the security deposit loan program that Senator Duff testified on. We're obviously in support of that. We think it needs some fine tuning. We actually looked at doing a similar type of a program close to 10 years ago with the Department of Social Services, who, as you folks know, has the rental assistance program themselves, and kind of putting a guarantee piece into it and using private funding through our banks. So we're looking forward to working obviously with the committee and also with Senator Duff and the other proponents to see if we can come up with you know, an approach that really does work for everybody who needs these deposits. And lastly, last bill that we'll talk about is the homebuyer savings account, related tax deduction and credit. Obviously, you folks saw this last year. We are still very much in support of it. Now more than ever, with increasing interest rates, low housing inventory, and higher prices on homes, the goal of being a first-time home buyer is obviously becoming more difficult to reach. So we believe that this bill would go a long way towards assisting people, especially because it's going to be just like the CHET program. It's going to be a tax-free income off of that will continue to compound at a much higher level and get the people to that first step where they can essentially afford to be a down payment, the closing cost, and get into their first home. The only thing we'd like to suggest on that, and you'll see it in our testimony, is that as the bill stands right now, it's only covering single family homes. We'd like to see that expanded to multifamily homes, 1 to 4 families. The reason for that is, and you know, you live around New Britain. I used to live in one of these 3 families when I was going to college. That's a great way for someone to get into a home, is through a multifamily, and also have the additional income, as you folks know, through the rental income. So that's our only suggestion as far as that goes, but good bill, ought to pass, and be happy to answer any questions.
Thank you, Tom. Since you mentioned it, on the security deposit loan assistance proposal, the bill is currently drafted, has a 25% guarantee on that. You have any thoughts on that?
Yeah, we think that's a little too low, quite frankly. There's a few changes that we'd like to see on the bill, that being one of them. Number one, you want to encourage banks to essentially start doing that type of lending or enter into the program. And it's a pretty robust, if you take a look at what the criteria that the bank has to meet, it's very robust. We would rather see, you know, a criteria which is more general through the Department of Banking, something along the lines that if a bank is in good standing with the Department of Banking, they do that on a regular basis. The list of criteria that they have in the bill is exhaustive, if you will. So I think there can be a way to simplify it, make it easier for a bank who's taking a look at the program to say, oh, okay, well, I'm just going to submit this application. But, you know, once again, those are fine tuning things that I don't think are going to necessarily be controversial. It's just a matter, in our opinion, of streamlining it, making it easier for a bank to sign up to essentially utilize this type of a program.
Okay. Representative Delnicky.
Thank you, Mr. Chair. And Thank you for the positive comments on the first-time home buyers program there. I think it could go a long way in solving some of the problems we have in housing and all that. I just want to pose this question to you pertaining to the financing. Let me find it here. Basically, the mobile homes that are stationary and the Bankers Association talking about long-term leases so as to ensure that there would be a place for that asset to be during the entire loan process, and some basically counterintuitive testimony we've gotten that a long-term lease would not be a good thing. What's your thought on that?
Well, I'm not sure what the argument is that it would not be a good thing from a banker perspective. One of the concerns is that if the lease is terminated or not renewed, that's going to put the mortgage loan in jeopardy because the mobile home has to leave the park, and you separate the mobile home from the land and the park. We think it puts our bankers think it puts the mobile home owner into a precarious situation and could have the domino effect of, causing them to have a problem with paying their mortgage loan. So having the stability of the long-term lease that would exceed where the mortgage loan would exceed the period of the lease would provide that stability, I think.
And of course, that was Bill 5345. And I'm trying to try to wrap my arms around the fact that there's testimony in one side about not wanting a long-term lease on the property, which it seems to me would guarantee the fact that a financial institution would want to then, if there was a long-term lease, that would be in place at least for the duration of the loan, of the mortgage, and it would make sense.
We agree.
Well, thank you for the comments there, and thank you for the support on the first-time home buyers. Thank you, Mr. Chair.
Thank you, Rip Del Nicky. Anyone else? One more before we let you go. We heard, I think it was Rip Del Nicky make a suggestion about on 188, the statements and the account holders and parties on an account about an annual notice. Are there currently any notices that were required by statute that are sent to depositors just as an annual reminder or annual notice or annual disclosures or privacy notice, or anything that is in that realm potentially of just an annual reminder or notice to a account holder as to what's going on with their account, any changes with their account or anything of that sort.
I think most accounts receive some form of statement or notification or communication about the account. There's not a requirement that there be something. So if the account is interest bearing, there'll be a statement. If it has any electronic fund transfers in and out of it, there has to be a statement. And let me back up. When I said interest, you'll receive an annual interest statement in connection with your filing your taxes. And as I said, if you have electronic transactions, which, try to have an account nowadays that doesn't have an electronic fund transfer coming in or out of it at some point, there'll be a statement that there's required. So, and then just the normal bank practices to send out statements. I think it'd be very, very rare to not have something come to, the owner of the account or the joint owner of the account that, reminds the person of the account. If I answered the question you had.
But specifically the bill before us here talks about identifying other parties in interest, whether it be a transfer on death or a joint owner or beneficiaries on accounts and things like that. I'm just wondering if there's any opportunity to provide a notice again to I understand the point about confidentiality, and Senator Martin mentioned putting names right in the window on the letter, when it was delivered, and what the concerns might be with that. But I just wonder if there's any other opportunity to remind the account holder as to who is, who is listed on their account. The scenario that he gave, where you have an elderly account holder and who may over the years be having folks assist with their banking. It would seem helpful perhaps to say that the account holder would have an opportunity to sort of review their accounts and status of their accounts, who else is on their accounts, and in case they somehow lose track of it. Just a
Yeah, my understanding, my understanding is that most statements, maybe not on the window, in the window of the envelope, would list all of the joint owners, for instance, but that most institutions do reflect the joint owners on the statements themselves that are inside the envelope. Where the issue kind of gets a little more problematic from a confidentiality standpoint are the payable on death designations. That's kind of the issue. So my understanding is the practice, although it's not required, is that most institutions, if not all of them, put all the joint owners on the account statements.
Yeah, and one of the issues I'd like to just mention is that it's a double-edged sword when you're looking at this. If you've got someone who's going to essentially be committing elderly crimes, right? Crimes against the elderly, and you've got a list of all the account holders that are on there, then essentially they've got the opportunity to have private information. And essentially, if they're trying to, pull a scam or a con or whatever the case would be, they know who's on that account. So it's more people that they would essentially have the opportunity to go after. And I think, as we saw from last year, and by the way, great job passing the anti-elder fraud bill last year, a long time in the making. That's a great step forward. And obviously we need to continue that fight, if you will, making sure that we can do as much as possible to protect that population. So with that said, there's always two sides to the story, not story, but it's a double-edged sword when you're going down that path. The other thing that you'll see in our testimony, and I think we mentioned this previously, is that when you have a beneficiary that the account holder does not want listed on that account, no matter what, for whatever reason they decide, that's really their decision at this point. So anything that we did that's different could essentially violate that privacy that they're looking for. So it's a difficult one to essentially thread the needle through, quite frankly, but we totally understand what Senator Martin was talking about. And obviously thank Representative Delnicki for the suggestion.
Just one more point that you may be interested in. So both federal and state law on account periodic statements expressly permit an institution to send an account statement where there are joint owners to just one of the joint owners, and there are operational reasons for that. And in terms of having to send out statements to several parties, there may be multiple joint owners, and so this law would sort of conflict with that. We'd have to figure out how the federal law overlays this law if this bill, if it were to require all joint owners to be addressed on the envelope. That would be a little bit of a hitch, if you will.
All right. Seeing no further questions. Thank you, gentlemen.
Thank you.
All right. Next, Teresa Dudek from Connecticut Fair Housing. Hi, good afternoon.
Good afternoon, Chair Doucette, Representative Santos, and Representative Delnicki. My name is Tess Dudek. I am a staff attorney at Connecticut Fair Housing Center. I represent homeowners in foreclosure. I'm here to support HB 5342 with one crucial amendment, which I'll get to. This bill can protect homeowners. Particularly here, I'm interested in talking about homeowners facing zombie mortgage foreclosures, which you've already heard a little bit about today. These so-called zombie mortgages are often loans that homeowners thought had been part of a modification or refinance or discharged many years ago and have heard nothing about them in years since, only to be blindsided years later with a foreclosure notice. Often from an unfamiliar company for a sum that's ballooned through interest and fees to a point where it's now unrecognizable. I know from experience that a statute of limitations as proposed in this bill would be effective to protect homeowners like the ones I talk to every day, or maybe not every day, but certainly weekly. And these would be in line, this statute of limitations would be in line with other states like New York and New Jersey that have a 6-year statute of limitations on the books. And nationally, we are among other advocates who are trying to advocate for protections for homeowners who are at risk of losing their homes because of this debt. However, this bill is only going to be useful if we can apply it to current mortgage contracts and not have the provision for contracts formed after July 1st, 2024. It's a straightforward modification of judicial procedure that we're asking for, and it doesn't invoke any of the hackles of modifying contracts. I just ask that you consider what would have happened if the foreclosure mediation program had been implemented after only for contracts formed after July 1st, 2008. That would not have helped the many homeowners that it assisted throughout the Great Recession. So I just ask that you strike the July 1st, 2024 provision and support HB 5342 with that amendment. And with that, I'm happy to take any questions.
Thank you. Thank you for your testimony and joining us. One question I did have, and you touched on it, you mentioned New York and New Jersey currently have statute of limitations. And, you know, I must confess too, as someone who practices in the real estate area generally, the concept sounds foreign initially when you talk about a statute of limitations applying to mortgage foreclosures, but then come to learn that many states seem to have it. Do you have a handle on how many states actually currently have? Are we in the minority?
I can definitely do a little bit of research. Some of the statutes of limitations have different flavors. So New York and New Jersey are of the 6-year kind of variety. I think in Massachusetts, and I can get back to you on this, it's related actually to 5 years after the maturity date of a loan. So it depends on the state. I can do a little more research and certainly reach back out.
No, it's interesting because the other thing I learned in looking at this further is that in New York, for instance, it's essentially covered in case law. It's a sort of common law thing as to when the statute starts to run and a case-by-case basis, and different lower courts in New York have arrived at different conclusions on that. So you're right. I suspect there's many different flavors across all the jurisdictions that have it. But to your point about the effective date, I just wonder, I was not here. This committee deals regularly with the foreclosure mediation program. You mentioned that as being one. I just wonder in terms of contracts, constitutional, takings, how are we able to address that potential defense or argument to that?
Well, first, I would just consider the fact that we are giving a large amount of time for mortgage holders to enforce their rights here. And often the servicers of these mortgages and the holders of these loans are not coming into this totally having fulfilled their duties as servicers. Often these are scammy companies who come in to try and take advantage of homeowners' hard-earned equity and sort of lie in wait to do so. That said, this doesn't substantially impair our contract at all, and in enforcing that contract, there's plenty of time for a mortgage holder to come in and take advantage of their opportunity to move for foreclosure and file their claim. So we don't feel that this is at any risk of impairing any of those contracts. And in fact, I would just point out that many of these zombie mortgages have come from, some of the unscrupulous lending practices of pre-2008 mortgage companies. So when we talk about, continuing to advocate for homeowners. Many of these are homeowners who are paying their debts, consistently paying their first mortgage consistently, and coming upon, you know, a totally blindsiding foreclosure action that's left over from, you know, an 80-20 from a company that's now bankrupt.
I think you're absolutely right. It was not an issue that I heard a lot about before, just, you know, recently within the last 2 years, I think. And so it's you know, very timely, and it's very much something that I think we're working through right now, that they're resurfacing like zombies. Thank you. Any other questions for Tess?
All right. Thank you so
Okay,
much.
seeing none, thank you.
Thank you.
All right, next on the list is Kevin Lally, coin flip, who is online, I believe. All right, Kevin, we see you.
Perfect. Co-Chair Doucette, ranking members Bertho and Delnicki, and honorable members of the Banking Committee. My name is Kevin Lally, Assistant General Counsel and Consumer Protection Officer for CoinFlip. Thank you for the opportunity to testify before you today to offer comments on HB 5211, an act concerning virtual currency and money transmission. CoinFlip opposes HB 5211 as currently written, but is committed to working with the legislature to enhance consumer protections in the bill. This proposed bill contemplates amending the 2023 bill HB 6752, specifically regarding its application to virtual currency kiosk operators. Since last year's session, CoinFlip has had continued conversations with the Connecticut Department of Banking, the Connecticut State Police, including Detective Matt Hogan, who spoke here today, and this committee to further those efforts. The discussions were productive, and both the Department of Banking and the Connecticut State Police were able to share their concerns regarding consumer protection and concerns of Connecticut constituents. After these meetings, CoinFlip is confident to work with the state of Connecticut. It looks forward to being regulated by the Connecticut Department of Banking, and will continue to work with the Connecticut State Police in order to implement procedures to reduce and investigate fraud quickly. Unfortunately, HB 5211 and its 2023 predecessor continue to rely on faulty policies such as transaction limits, fee caps, and refund language that create a false sense of consumer safety while not addressing the root cause of scams and fraud. The proposed transaction limits do not adequately consider federal reporting requirements, encouraging the structuring of transactions to further obscure, creating less transparency and information being reported to law enforcement. The addition of fee caps does nothing to prevent consumer fraud, and in combination with transaction limits, inadvertently creates incentives for less transparency. Lastly, the refund provision displays a misunderstanding of blockchain technology and creates an unintended consequence, as scam artists will seek to game the refund period and defraud virtual currency kiosk operators. CoinFlip is a money service business registered with the Financial Crimes Enforcement Network. As a money service business, CoinFlip is subject to the Bank Secrecy Act, the United States Patriot Act, and their implementing rules and regulations. Unlike some others in the industry, CoinFlip believes smart regulation is good for business. We believe that a regulatory framework is necessary to protect consumers and encourage innovation. And we believe the following enhancements will help to improve consumer protection in the bill. First off, to require licensure within the state. CoinFlip agrees with the state of Connecticut's current proposal to require a money transmitter license for virtual currency kiosk operators. This license would implement baseline requirements similar to other financial institutions, and it additionally would allow state oversight and periodic audits to determine the adequacy of compliance, finance, and cybersecurity programs. To require robust compliance, we believe all virtual currency kiosk operators should be required to directly employ a qualified in-house chief compliance officer and compliance team that do not have a large ownership interest in the company. 3, to require clear warnings and fee disclosures. CoinFlip agrees that all virtual currency kiosk operators should clearly disclose prior to completion of a transaction all fees associated with the transaction, as well as relevant warnings. To require blockchain analytics. The use of blockchain analytics technology should be required to prevent fraud prior to a consumer transaction by automatically blocking transactions that are being attempted to be sent to high-risk digital wallets. Since April 2022, CoinFlip has automatically blocked more than 1,230 transactions using blockchain analytics. CoinFlip additionally has the ability to blacklist digital wallets, preventing their future use at any CoinFlip kiosk. Additionally, we would ask that you require live customer service. Customer service is considered the first line of defense of any adequate compliance program. As a result, every virtual currency kiosk operator should be provided trained live customer service. Between December 2023 and February 2024.
Kevin, sorry, your time has elapsed. I think the committee probably will have some questions. Any
Absolutely.
Rep Delnicki.
Thank you, Mr. Chair, and thank you for your testimony. I have a tough time believing that there can't be a refund. And to that, it sounds very difficult to be believed based on the fact that, you know, we have all this technology, and to say that there's no way somebody could get a refund doesn't make any sense to me. Maybe you have a good answer to that.
Of course, Representative Delnicki, I think that there's a misunderstanding that hopefully I can help advise on. First off, I think that what most operators are trying to say is that once a virtual currency transaction happens, once the virtual currency is sent to a digital wallet, there is no technology that would allow for that virtual currency being sent to be reversed. Now, virtual currency operators could provide a refund via a bank wire. They could provide a refund in another way, whether it's mailing a check. The problem in that circumstance is that virtual currency operators are directly selling to customers their own stock of virtual currency. So in an instance where someone sells $2,000 or $2,500 of virtual currency and is asking for a refund, the operator is then out both the virtual currency that was sold as well as the $2,500 that was spent on it. This is encouraging individuals to make false refund requests or looking at the price of Bitcoin, any other virtual currency, if it goes down, having buyer's remorse. This isn't a refund in the normal definition of the request.
That certainly is not a definition of a refund the way you would think of it. And I go back to my original premise that anything and everything should be able to have a refund to it. I understand the concept that an operator is selling their Bitcoin or whatever it is, virtual currency, to a customer, but nonetheless, there's real money that came across, and it should be reversible in some fashion so as to make the person whole if they suddenly realize that, oh, I had no clue what this is and what's going on here. And again, I find it very difficult that there isn't a level of consumer protection when it comes to that.
And I understand your concern. I believe that there is a number of consumer protections that go in before that. And that's making sure that consumers are adequately educated, adequately warned, using what we would consider the traditional modes of consumer protection. But besides that, you want to make sure that we're using top technology in order to facilitate safe transactions on the back end where the consumer does not see. And that's making sure if there's any kind of fraudulent transaction that's known with a digital wallet address, that even if that consumer tries to transact with that wallet, it will be automatically blocked. That is the type of technology that we use. It's the type of technology that we have implemented and the type of technology that we encourage the committee or the legislature to implement as part of this bill.
And I understand the concept of the digital wallet, but we really are dealing with cold hard cash on the front end. And it seems to me that there should be some way to do that. Thank you, Mr. Chair, for the opportunity to ask the question.
Thank you, Representative. Kevin, did you submit written testimony for us today?
It has not been submitted yet, Representative Doucette. It will be shortly.
Okay, that would be great. I asked because you mentioned a few suggestions, which I don't believe are in our bill or in statute now in terms of additional protections or criteria that would apply to licensees. Could you go through that again? You mentioned having a chief compliance officer, a few other things in
Yeah,
there.
absolutely. So first, obviously and it's already in your bill, the licensure in the state, which I believe is essential. The in-house chief compliance officer, we've noticed that some other operators will have a chief compliance officer that has no experience in compliance, that has a vested interest and an ownership interest in the company. As a result, we believe that those individuals have conflicting requests within the company. So we would highly encourage that the chief compliance officer be both qualified, which would be something that you would oversee in the MTL framework, as well as not having a large ownership interest in the company. The use of blockchain analytics, which I described earlier, is making sure that you're using third parties to block transactions, as well as using blockchain analytics to investigate transactions to help out law enforcement as quickly as possible. I think any police officer that's dealt in this area knows that moving quickly is more important than almost anything else. Requiring live customer service, any compliance program, whether it's for a cryptocurrency company or traditional finance, is known that live customer service is the first line of defense. We make sure that we train our customer service at least twice annually on BSA AML standards and how to find fraud. These individuals are stopping transactions within the state of Connecticut and across the United States when they notice this type of fraud. And lastly, requiring robust policies and procedures. We suggest an anti-fraud policy and consumer protection policy that would outline specific risk areas of the virtual currency kiosk operators, how they will protect against those risks, and how the company will handle any refund requests that we were just discussing earlier.
Okay, thank you. Yes, again, please, if you could provide written testimony, I was jotting down those notes, but it would be great to have that as we go back.
Absolutely.
And look at potential amendments to this. Rep. Delnicki has another question.
Yeah, thank you, Mr. Chair. I'm going to be asking, I know we've got a number of folks that deal in Bitcoin that are going to be testifying. And I want to ask each one the same two questions. First question is, what protections do you have for senior citizens that may not understand this technology? And I could put myself in that category at one point. What protections do you have for them?
Absolutely. So I think let me start with the traditional consumer protections that we were discussing earlier. So we make sure that we have 24/7 customer service, live customer service. So if you call any day of the week at any time to ask any question, we'll make sure that we have someone there to guide you through the process and that can possibly notice any issues that you are undergoing. That number is posted physically on our kiosk. It's also on all of our digital screens. Secondly, we have numerous warnings within our system along the way in our terms of conditions, but also large warning screens that tell individuals that if they were sent to the kiosk for payments, if they were sent to send money to an individual they don't know or purchase cryptocurrency for an individual they don't know, to stop immediately and call customer service. Thirdly, we have enhanced due diligence policies within our system, and that's to recognize that if there's individuals that are spending a certain amount of money on first transactions, or if they're spending a certain amount of money during a specified period of time, whether that be a month, a week, 2 weeks, that those individuals can be put on hold. We can reach out to those individuals and make sure that, one, there's no anti-money laundering concerns, but there's also additionally no fraud concerns.
So you can actually freeze a transaction, but you can't refund it and do you deal strictly in cryptocurrency? eh, Or do you actually also do anything with non-fungible tokens?
So first off, we can freeze the transaction before it occurs. Unfortunately, as I mentioned earlier, once a transaction is sent on the blockchain, there's no technology that is available that I'm aware of where we could reverse that transaction. Secondly, we specifically we have a number of virtual currencies that we deal with, but we do not deal with any non-fungible tokens.
Okay, thank you. Thank you, Mr. Chair.
Thank you. Okay. Seeing no further questions, thank you, Kevin, for joining us today.
Thank you, Representative Doucette.
Next on the list is John DiOrio. Welcome, John.
Thank you, Chair Doucette. Nice to see you all today. Vice Chair Delnicki, Representative Santos, I submitted fairly comprehensive testimony on my main concern with 187, which I'm happy to answer questions about, but I'll supplement that a little right now with concerns with the testimony I heard earlier. First, the registration of a mortgage servicer. And the reason given for that is the technology related to NMLS. That's a red herring. It's not real. All we need to do, if you would like to expand that bond requirement, is do it under your mortgage lender statute. Expand the amount of that bond, file one bond instead of two bonds. Doesn't make sense as it was laid out for you folks. The fee prohibition in Section 9. I've been paying close attention to the EWA issues where, I think it's critically important that as you guys consider these bills, your eyes are wide open and your understanding is crystal clear, right? Because imagine being a business owner and it's not crystal clear. And the next thing you know, you have a problem that you don't anticipate. So that fee prohibition seems to be slid in there in that context. Redefining sales finance company. I would like to see more information on why and what that's really all about. As I see it, as it's currently in the bill, there doesn't seem to be much there. And then lastly, there was a little discussion about resources to do certain things that you guys would like the department to do. And I think that's always a tough situation for you guys, right? There's always limited resources and plenty of demand. But I do want to point out that if you look at the last 3 years of the banking department's annual report, they're running an $80 million surplus. So I think the resources might exist. Maybe it's just a simple reallocation question as opposed to a real problem. And that's really it. My biggest concern is 492C. It's an extremely simple fix. The fix that I have prescribed is exactly what the legislature intended in 2009 when they passed the bill. And it's literally the striking of 3 words and a couple clarifying notes. Other than that, I'm happy to take any questions that you may have.
Thank you, John. The 492C, is that currently covered in 187 or no? Would that be?
It is. That's the change that they're looking to make
Section
is
1, right?
Yes.
Okay.
Yeah. It's related to the electronic filing of the bond. It doesn't address the concerns that I've laid out in my testimony, but if you're going to do it, we may as well do it all at once.
And remind me what we have your testimony here, which is lengthy. Remind me what your suggested change to 492C is.
All right. So the enforcement actions taken by the Department of Banking against non-depositories have to be done in accordance with UAPA, Section 54 of the Connecticut General Statutes. And as when you are a mortgage lender and you have a bond, if that bond gets canceled by the bondholder, right? The banking department gets notified of the cancellation. The lender gets notified of the cancellation. And the issue there is the bond's purpose, right, is to provide insurance. That's what a bond is, to protect the banking department's interests, second, quite frankly, and to protect consumer interests first. And those insurance policies, just like any other insurance policy, have a term. So if a bond company cancels your bond, generally they'll give you a long runway of notice. In my particular experience, it was 90 days of notice. Well, license holders in the state of Connecticut are supposed to have something called the second chance doctrine, according to the Supreme Court, which enables a licensee, if something is wrong and they're not killing people and hurting people, they can fix it and everyone kind of moves on with their day. The way that it's being enforced now, which is you cease doing business, right? So you're not acting as a mortgage lender anymore. You've provided all the documentation necessary to the department so they know you're not acting as a mortgage lender anymore. You don't need the insurance anymore, which is why 492C reads, cease doing business and surrender your license. Well, when they passed the SAFE Act in 2009, right, the surrender of the license wasn't to happen anymore to the department directly. It was to happen, quote unquote, through the system. So the legislature tagged onto the end of that, cease business and surrender your license pursuant to 490, which to the legislature at the time meant on the system. So you're not doing the regulated activity anymore. You clearly don't need the insurance anymore because you're not, all the regulated activity that you've done is covered by the bond that got canceled. Just because they canceled the bond doesn't mean they cancel the coverage retroactively. They cancel the bond on a date specific. So if after that date specific, you are no longer participating in the regulated activity, you don't need the bond. Well, the department's interpretation is they don't have to accept it, which under 36A51C, they are statutorily allowed to set terms and conditions for acceptance, which we read quite differently than outright reject. But in a case that I happen to be somewhat familiar with, they knew that the company was no longer acting as a mortgage lender. They knew the company no longer needed the insurance coverage, but they rejected the surrender because of a parallel enforcement action to create a condition where, quote unquote, you had a license but not a bond. It's a complete perversion of how that is supposed to work. What should happen, and what I have suggested in my testimony, is either get rid of pursuant to 490 and rephrase that as on the system or on the NMLS, however you want to do it. It's really a very simple change. Or make it clear that, yeah, you don't have to accept it, but you do have to set terms and conditions for the acceptance. You can't, let me give you an analogy. You own a car and you insure that car because you're required by state law to insure that car. And if you're on the road and you hurt somebody, you need to have insurance. But if you're not driving the car or you don't have a car, if you're not doing the regulated activity, you don't need the insurance. It's the exact same thing. And companies should be able to, go through the administrative process without being shot in the head before it starts. And what this particular law, as it's currently written and being enforced, doesn't allow that to happen. And it's a super easy fix, does nothing to put either the banking department or consumers at risk. It's just the right thing to do, especially if OLR goes back and looks at 09-209 and looks at the correspondences between the legislatures and the testimony and so on and so forth, it's pretty clear what was intended.
Okay,
And that's not how it's being enforced.
okay. Okay, thank you.
You're welcome.
Any other questions for Mr. Diorio? Anyone? Okay, seeing none. Thank you, Mr. Diorio.
Thank you, gentlemen. Have a great day.
You too. Next on the list is John Potter. Welcome, John.
Good afternoon, Chair Doucette and Miller, ranking members Bertel and Delnicki, and committee members. Thank you for the opportunity to testify. I'm John Potter. I'm here for Dapper Labs and Sorare, two leading companies in the business of issuing and selling non-fungible tokens, also known as NFTs. I'll focus on a very small portion of HB 5211, which is Section 6 near the end, that would authorize the banking department to regulate NFTs. Joining me today are a Barbie doll and a Toy Story Woody doll. Pictured in my written testimony are a Barbie NFT and a Toy Story Woody NFT. The banking department, of course, does not regulate dolls. But this bill could authorize the department to regulate NFTs, the NFTs of the dolls. A few years ago, excited investors and tech industry glitterati spoke of NFT's powerful blockchain technology and basked in the aura of crypto. But today, a more straightforward narrative has emerged. NFT companies create and sell digital art, music and sports videos, concert tickets, even college diplomas. The NHL Breakaway Store sells NFTs that memorialize great hockey moments. One day there will be a Hartford Whalers Gordie Howe NFT. Artist Jessica Ragsy Ewood in Redding, Connecticut is a famous Lego creator. She also sells Lego-themed NFTs. The special sauce around NFTs is the underlying digital asset's verifiable authenticity or uniqueness. With NFTs, we can each own our unique Barbie or Woody card. NFTs and blockchain, however, are simply technology, like pipes and plumbing. Pipes can transport gasoline, water, beer, or chemicals, and are regulated differently based on their contents and use. Similarly, digital assets that are underlying NFTs can be sports, music, health records, stock certificates, or currency. And they should be regulated based on their specific use, not all bundled together because they are all NFTs. If NFT technology is used to produce or distribute securities, payments, investments, or other financial services, they should be regulated by the banking department. But when NFT technology produces and distributes art and music, they should not be regulated by the banking department. They should be consumer products. That's why we request that this bill be amended to either remove the provision in question, because we believe the law already provides the department the authority to regulate any product that is a securities and financial services product, or to clarify that only financial services NFTs are subject to department regulation. To be clear, I don't know of a single use case when NFTs have been used to access, distribute, or authenticate securities, currency, investment, or credit products. But they could be, and in those cases, they should be, and arguably already are regulated by the department. I'm confident the committee does not want to expand the banking department's jurisdiction to cover Barbie dolls. I'd like to make that clear. Thank you.
Thank you, sir. And I'm inclined to agree with you on that, the Barbie or the Woody. But I did want to highlight, I reviewed your testimony here quickly and got ahead of you. And you got to sort of, from, I think, our perspective on how and if to best regulate, or in fact, it would be our perspective in the bill as it's drafted to allow the Department of Banking to promulgate regulations if that's what were to come to pass. But you say there is the potential for the case where NFTs have been used to access, distribute, or authenticate securities, currencies, or other investment or credit products. And you mentioned a financial services NFT. So could you clarify, what those scenarios might entail? What is a financial services NFT as you would describe it or define it? And
So
what sort of regulation would we potentially want to apply?
So the answer is yes, sir. An NFT can be used to authenticate a stock, a share of a stock. Similarly, that a piece of paper can be printed out to replicate and represent a share of stock. In the instance when it's a piece of paper, it's not regulated like a share of stock or by the banking department. In the instant when it becomes a stock certificate, then it is. I believe that a careful reading of the current law already says that if anything is reflecting something that is a security or a share of stock or a credit or an investment, then it is already regulated by the banking department. If you took anything off the shelf, a piece of cardboard, a shovel, and put on the shovel that it was representing a share of stock, then that would be regulated by the banking department if it was then used in a way which was going to be harmful to consumers or required registration under the banking department's laws. So I think that in California, for instance, the Department of Financial Services regulates everything. Somebody put in there that they wanted to regulate cryptocurrency and things on the blockchain, and we created careful definitions. In New Jersey, we created a very careful definition. It didn't make it through, but we negotiated it with the Securities Division and the Attorney General, which is actually where the Securities Division is housed. And we just said this is a consumer product digital asset, and this is a financial services digital asset. And only one of them is going to be regulated by the Securities Division, and it wasn't the consumer product. So that's one way to do it. We think the law is already clear the way it is. But if we wanted to do something, if you wanted to do something, one way to do it would be to define what is a financial services digital asset and what is a consumer product digital asset.
That makes sense to me. And if you would be willing to share that with us or point us to that,
Sure.
That would be helpful. And yeah, no, I guess in your business model, as it sounds to me, there is no financial services aspect as you would describe it per se. But, again, it occurs to me that there is a segment of the market here where you can have, an NFT wallet, or I know Ethereum is a place where you could essentially have NFTs in your wallet that could potentially be used to either authenticate or be exchanged with other forms of digital assets. Is that not true?
I know there's crypto wallets that have cryptocurrency in them, or ETH or other things like that. I don't know that if the NFT goes in your wallet, but it wouldn't surprise me if you store it there. But the fact that it's in your wallet, my driver's license is in my wallet. My driver's license isn't currency. It's not a security, right? It has it's a product that happens to be stored somewhere, but that doesn't make it into something else that it's not.
Okay. Rep. Delnicki.
Thank you, Mr. Chair. And I'm just looking over your testimony in the Marvel comics and the Top Shot, all that. So hypothetically, would an NFT be considered an investment, or is it just a casual collection, for lack of a better term? And I use the standard of, I used to collect NASCAR diecast and get them autographed, and I physically would have them as opposed to electronically have them. Is that the same kind of thing, or what?
I think the answer is yes. It's a collectible. And, what you think of as something you treasure that sits on your shelf, would other people think of as something they would pay $1 for and maybe sell for $5 on eBay, or $500 or $5,000, like Jordan sneakers? The answer is sure. Everybody interprets it differently. The banking department doesn't regulate houses, but people buy houses as investments. So the fact that something is an investment doesn't make it a security or a financial service or a financial product. And that's the line I think we have to be drawing here.
So in theory, you could have what I called a collectible NFT.
100%. That's exactly how we present them, as digital collectibles.
And conceivably, you could have an NFT that would be some kind of an investment. Is that possible or not?
Let's start from the premise.
And I only raise that issue because, it is in the agency bill, pertaining to regulating it, and I just want to try to, stake out the ground and understand completely how the NFT works.
So the NFT is plumbing. The NFT is just a technology, just like we used to have floppy disks and now we have the cloud. And it's just the iteration of technology moving forward. So an NFT can be used. California is talking about car titles with NFTs, right? Protecting car titles or authenticating car titles with NFTs. Whitman College uses NFTs to authenticate your diploma. Health records are going to be NFTs. It means it's stored on the blockchain. It means it's authenticatable. The transaction record is essentially public with publicly accessible NFTs. Obviously, you wouldn't do that with your healthcare records probably, but there are ways but at the end of the day, so an NFT can be authenticating and providing, guaranteeing essentially the provenance and the accessibility to your LeBron James 40,000th point basket, or Caitlin Clark breaking the record, right? It's your digital moment, right? The NBA Top Shot sells moments, and it can be video, it can be just a single frame. Disney sells collectibles, right? They just happen to sell something you can hang on your wall, or they hang something that you can put on your big screen TV. And it's authenticated as unique. It's yours. And when you sell it, you probably can't ever watch it again because you've sold the rights to access it. So whether it's a digital asset or a physical asset, whether it's a property record or a car title record, the NFT is literally on the ledger as representing somebody's access to or somebody's ownership of X, and X can be digital or physical.
So for authentication purposes on the NFT, and you talked about, like LeBron James scoring how many points he did, or Dale Earnhardt winning the Daytona 500 as an example. How would that be authenticated, and how would that actually be if somebody wanted to sell it?
Now you're asking me technical questions that are above my pay grade or parallel to my pay grade. But the short answer is I can't tell you. I could bring a technologist in to tell you. We could set up a phone call or a video chat afterwards. What I can tell you is that there's a high level of confidence that this works. And governments are obviously adopting all sorts of blockchain technologies, and there's reasons for governments to move into the technological space on their own. So I think that if California wants to do car titles on NFTs, I can't tell you what the value proposition is, but it's something that they're going forward and doing. I do know that there's a consumer value proposition here that is different from an investor value proposition. And let me be fair. If somebody is running a pump and dump scandal to sell NFTs, that's still securities fraud, right? That's still investment fraud is probably really what it is, because they're not selling securities, right? Just like it would be a pump and dump scandal if they're selling penny stocks, or if they're selling houses that don't exist, right? In a boiler room. Or a land scam. This distinction between consumer products and investment or financial products doesn't affect whether the criminal law applies, doesn't affect whether consumer abuse applies, doesn't affect it. It just says that this product itself is not a financial services product. If it's abused for financial gain, it's still subject to all the laws that would otherwise be subject to.
It's interesting. I did a little bit of research before I came to the meeting on this, and I've seen examples where there was initial offering of an NFT and it went for some ridiculous sum of money. And then literally 2-3 months later, it was almost worthless. And I'm wondering, is that the kind of thing that would be like an investment product?
No. If somebody overpays, somebody paid $187,000 for a Giannis NFT. Giannis, the Milwaukee Bucks basketball player. It was unique. There was only going to be one. It was like buying an original piece of art. That's the way the buyer thought of it. If the art became less valuable, that didn't make it an investment product. It was still, that person might have thought he was buying an investment, but that didn't make it an investment product.
Well, I'm glad you came forward. And I probably learned more about NFTs than I really wanted to, but I'm going to use a cliche. It's a brave new world. Thank you for your testimony. Thank you, Mr. Chair.
Thanks, Rep. Delnicky. Any other questions? Okay, seeing none?
Thank you, sir.
Appreciate you joining us. Thank you, Woody and Barbie. Next is Pete Myers.
Good afternoon.
You didn't bring any visual aids with you?
You know, unfortunately for this, I can't bring, I
Yeah.
guess I could bring Barbie's dollhouse in for
Yeah.
the first time home buyer
Yeah.
account. I guess I could do that.
Yeah. No, that's good. Some committees have, rules on such things, but, we welcome it here in the Banks
Well,
Committee.
we
So,
appreciate the openness. So yes, I'm Pete Myers from the Connecticut Business and Industry Association, where I have the privilege of covering housing policy for us, banking, and a few other committees. And this one really ties banking and housing together. So I'm here today in support of House Bill 5344, and we've submitted written testimony on this. And this is actually one of our CBIA's policy priorities for this session, was to create tax incentives for first-time home buyers. And this really does that by creating a first-time home buyer savings account with related tax deductions and establishing a credit for employers. And we like to say this is really tackling two of Connecticut's problems in one bill by helping employers to recruit and retain employees, and by helping to make the cost of housing a little bit more affordable in the state of Connecticut. Now, this bill would allow an employer to contribute to this account, receive a tax credit for doing so, would allow an employee to contribute to the account and receive tax deductions for doing so, to really incentivize that employee to be able to buy their first home here in the state of Connecticut. Now, I want to point out that accounts similar to this have been created in states like Iowa and Oregon, and I believe 12 other states, including those. But each one of them has really been different. And our goal of this, in working with the other advocates and the committee, was to really make a bill that would fit towards Connecticut by allowing the employer to contribute. Now, it's to the best of our knowledge, this would be the only account in the country for first-time home buyer savings account where an employer would be able to contribute as well. And that's really a testament to our employers of Connecticut coming to us and saying, one of the main issues with hiring employees in our state is when they're looking to recruit, looking at a trade schools, looking at a colleges, they're looking at the state of Connecticut has a really high cost of living and a really high cost of housing. So when you're right at a school, myself included, as someone who just graduated MBA school a few years ago, you look at, okay, is this state affordable for me? And if there's programs like this that an employer could offer as a benefit, we would like to see employers be able to do that. So as I've said many times this year, Connecticut has over 90,000 jobs open. And to help fill those jobs, we're going to need recruitment tools like this. And we would be supportive of this bill, which would allow it to do that. And additionally, we want to point out that a bill similar to this came out of the committee last year, and I believe the year before that. And we were supportive of it then, as we are now. And we want to commend the committee to working with OFA and the other advocates to really identify the cost of this bill. Iowa, I believe, in the past few years has had 200 people utilize it. So the fiscal note on it, we appreciate OFA's work in the past on properly putting a proper fiscal note on the bill. And additionally, we look forward to working with the committee to properly incentivize employers and employees to contribute to this account. And I'll stay under the 3 minutes today.
Thank you, Peter, and thank you for your advocacy on this. Thank you, like you mentioned, we've had this for several years now. The committee really likes this concept, and we appreciate you leading the charge, as it were, this year on it. One question that came up as we're trying to, and to your previous point about OFO, trying to figure out what the potential fiscal impact is, in trying to right size the tax deductions, and what we came out with here, just in terms of discussing the drafting of it, was a tax credit on the employer side. And I believe there is precedence, but if you have other examples on a tax credit for other programs that we have out there in our tax code, and and what maybe the right amount is, if there are other examples of other tax
Sure.
credits and what maybe the right amount is. We chose 50% as a tax credit, and I guess we still, I'm still wondering, is that right? Is that too rich? And, and last point on this is that I think we've heard one bill that came through this committee was the student loan repayment and tax deduction and resulting tax credit that was taken on the employer side. And we recently heard from OPM that program was not getting a lot of utilization. So we want to try to expand it. So again, the question is, how do we get this right so that people be able to enjoy this incentive out of the gate?
Yeah, absolutely. I think properly incentivizing it is very important. And I can follow up with our VP of Public Policy, Chris Davis, who handles tax policy for us, to get you that exact number. But I 50% sounds fantastic, but we're aware that the fiscal constraints on that might be a little costly. So we're more than happy to work with the committee on finding the exact number there. And we're happy to follow up with you on that.
Okay. Questions, Rep. Delnicky?
Thank you, Mr. Chair. Well, this is really encouraging. This is something that I think I broached the issue about 4 years ago, and every year it's gotten better. And I want to say it's kind of like a cake baking in an oven. And I think we've reached a point where it's time to put the candles on the cake. Simple analogy. The tax credit, I think, is that icing on the cake that really makes it what it can be and a successful tool in retention of people, getting people to stay in Connecticut. I know that virtually every business is having trouble recruiting people. It's almost like there's a shortage of folks that actually want to go out there and work. So having a program like this, if we can actually get it across the goal line, I think will be a big help. And I want to commend CBIA. And of course, I think that's Representative Davis out there. Commend you guys, you folks, CBIA, for actually taking what was a good idea and making it a great idea, and something that I think we should all be able to embrace and get across the finish line. And I want to thank you, Mr. Chair, for that opportunity to speak on this.
Thank you, Representative. Representative Santos.
Thank you, Mr. Chairman. Rep. Delnicky took most of what I was going to say, but I appreciate that. I haven't been here long enough to follow the trajectory of this bill over the 4 years or sessions that you mentioned, but I do value its importance, right? And especially being in the employment market for the state of Connecticut. We have these open jobs, we can't fill them. What we're finding is that the jobs that offer the most well-rounded benefits to employees are the ones that people are looking for, right? And it used to be that a person could stay in a job for 10, 15, 20, 30, 40 years. But nowadays there's so much competition as it is out there for these kinds of incentives for people to move and benefits. And so I know you've talked about this a bit in what you were saying, that the importance of having some kind of benefits that can make a job more attractive for someone, right? And something like this, when it comes to first-time home buyer, the reason I'm saying that is if you're moving into the state, you want to be able to have some kind of incentive to be here, right?
Yeah.
And so in the CBIA's view, this is something that can be a bonus, right? That's exactly what you said in your talk.
Absolutely, Representative. Thank you for the question. It's something that, like I said at the beginning, it's really 2 birds with 1 stone here, really helping to lower the cost of home ownership in our state, and also really giving employers ability to recruit employees, especially around our neighboring states. You look at Massachusetts, Rhode Island, New York, they don't have programs like this that would give employers the ability to really put some skin in the game and add that extra benefit. And additionally, looking in state, we have some of the best trade schools, some of the best colleges in the country in Connecticut. So keeping those graduates here, offering them jobs in-state in the manufacturing space or at a trade school, in a regular office setting right out of college or university, those are jobs that we want to keep those residents in-state. We're educating them here. We might as well keep them here.
Absolutely. And I think that you just said something really important there. Folks, perhaps in our generation, they come to school here or they grow up here and then they find other places to go. We want to make sure that we can keep younger folks here as well and make Connecticut attractive for all. So thank you for your advocacy on this.
Thank you, Representative.
Thank you, Representative. Okay, seeing no further questions. Thank you, Peter.
Thank you very much.
All right, John Carroll is next on our list, and he's joining remotely. I see he's logged in. There you are, John.
All right. Thank you, members of the committee. Thank you for the opportunity to testify today in regard to Raise Bill 5211. I had submitted a rather lengthy testimony and bill markup in advance of the hearing today. Rather than rehash the particulars here, I encourage you to review it if you haven't already. My name is John Carroll. I'm the Chief Compliance Officer of RocketCoin. We operate a nationwide network of approximately 2,300 cryptocurrency kiosks in 48 states and Puerto Rico, carrying money transmission licenses in 21, including Connecticut. These kiosks allow the customer to purchase and in some cases sell cryptocurrency in person and directly with the company. While the company's operations began in Chicago, Illinois in late 2015, our first kiosk in Connecticut went live in December 2020. Although we are listed as in opposition of the bill today, a more accurate label would probably be support and oppose. RocketCoin wholeheartedly supports the common sense and constructive guidance and regulation in this space. We oppose the regulation passed last year based on its inaccuracies and contradictions and measures that we felt missed an opportunity to make a difference. We hope that Raise Bill 5211 would address some of the shortcomings of last year's bill, but instead I think most were left untouched. We are therefore opposed to the bill as presented. But we are strong supporters of regulation in this space and believe that there remains an opportunity here to make this bill one that can truly protect the consumer, place trust in the kiosk operator, and not stifle a growing industry. We oppose the transaction limits placed within this bill because they negatively affect our ability to detect, stop, and report suspicious activity. They obscure customer transaction patterns and prevent the sharing of information with law enforcement. Ironically, I think the transaction limits expose customers to some of the very dangers we're hoping to eliminate. Arbitrary limits do not truly protect the customer. Communication, education, interaction does. The transaction limits aim to protect a subset of customers who find themselves at risk among the literally thousands upon thousands of cryptocurrency transactions processed each day within the industry. But inconveniencing an entire group for the protection of the subset by limiting transactions or access is not an effective solution. The most effective form of customer safety is intervention and communication, which RocketCoin does. Our proposals include mandates for this, more effective warnings pre-transaction, new customers being contacted if transacting over a certain threshold, elderly customers being contacted prior to their first transaction being consummated, wallets not being shared, blockchain analytics being required of all kiosk operators, requiring live customer service staff to communicate with customers over recorded lines, not text messages, chatbots, voicemail, and robust compliance policies and procedures run by actual employees of the company and not disinterested third parties. It should be part of any true plan for customer safety. And looking beyond RocketCoin, looking beyond Connecticut, RocketCoin envisions such a law serving as a template for other states as they try to address cryptocurrency in general, and specifically the kiosks found within their own borders. RocketCoin so believes in its compliance models that it would welcome it to be implemented nationwide. With that, I thank you for your time and am willing to answer questions.
Thank you, John. One question, and sorry to pick on you, it's been mentioned a couple times already, but I guess in light of last year's bill, I would, I suppose, take issue with the contention that the transaction limits are bad for consumers. I guess the intent, speaking for myself at least, was that by restricting the amount of the transaction by keeping it below an astronomical number where somebody could lose a lot of money in one shot in a fraudulent transaction. And then also, with the concept of the refund, we were protecting both the consumer and potentially even the kiosk company from having to be in a position where they're losing a huge amount of money in a single shot. So what am I missing about that?
Well, we're very concerned about the customer in the scenario that you described. But one thing that we do have to that we see in the industry, and we have to keep in mind, is that customer with just a transaction limit in place, that customer can go to multiple operators and wind up being exposed on different different amounts, different places, and can cumulatively wind up being exposed in a very real way. The nice thing about not having transaction limits and having that customer transact in one place only, especially a place like RocketCoin that has the customer protections in place, the interventions and the interactions, that's the kind of thing that really protects the customer. Just the transaction limit just doesn't successfully do that. The other piece about the transaction limit is that we as operators are constantly monitoring transactions and observing patterns and whatnot, and that all that sort of information gets destroyed in a transaction limit situation. And I sort of made reference in my testimony to some of the information that we can send off to law enforcement. A lot of that gets destroyed too because customers never reach those thresholds. And I think that the gentleman from Pointfield made reference to it as well, that we don't get to those transaction thresholds where we can start to make determinations, collect the right information, and also report the right information. So we have a situation where that it just doesn't quite mesh. And what we're trying to argue is that really the true protection is that customer intervention piece where you're talking to the customer and trying to discern whether or not they are at risk. And I think that's more effective. Really quick, you mentioned the refund scenario, and I know that there was some confusion with that in the earlier testimony. I did want to sort of address that if I could. In terms of a refund, as it's written in the bill currently, an individual can simply just ask for a refund and receive it. There's no obligation for that person to return the product that they purchased from us. We have to remember that we are selling them a product, much like, using an analogy, I guess if I went to Best Buy and I gave them $1,000 and they gave me a computer, I can't go home and call up Best Buy and say, I don't like my computer, I don't want it anymore, give me my $1,000 back, I'm keeping the computer. And that's really what the bill as it's written right now, that's what it allows the person to do. And so we have a scenario where it's really not good to the operator. And I understand the intent, and I applaud the effort, but I think it needs a little bit of work. Certainly as far as a first-time customer refund scenario, if they send us the cryptocurrency back, obviously we can give them that money. But it is not something that we can, it's unreasonable to assume that the kiosk operator will just be like, okay, and here's your money back, because we gave them something of value, not just like some sort of service that they get a refund for, if that makes sense.
Yep. No, that makes sense. Good point. Any other questions? Rep. Delnicki.
Thank you, Mr. Chair. And I'm going to ask you the same question that I've asked a previous purveyor of Bitcoin, about cryptocurrency. What protections do you have in place for senior citizens that may want to try this?
So senior citizens are, an at-risk group, and we're very concerned about their well-being. We don't want to exclude them from cryptocurrency or anything like that, because they have every right to purchase cryptocurrency as anybody else. And there are a lot of very interested senior citizens that want to do it. But we recognize it as a risk. And so we do things a little differently. What we do is I've said 100 times, I guess, but we talk to that customer, and here's how that works. We wind up, we have attestations and warnings on the screen on the kiosk as they approach it, right? So the the elderly customer comes to the screen, they are going to see the warnings, they're going to see the attestations that they have to attest to. They're going to obviously KYC themselves and give us their identity. We will then, if they are above a certain age, and I don't want to go into exactly specific what age because I don't want to give away our policies, but if they reach a certain age, then they their profile creation, if you will, is suspended until we can talk to them. And when we talk to them, our goal is to ask them questions about why they're purchasing cryptocurrency. And again, this is not to try to call them out or anything, but what we really want to be able to do is be comfortable that this individual is there for the right reasons. And we go through a series of 6, 7 questions, depending on you know, how old the person is, and then also what the sort of risk typologies that we're concerned about at the time are. And so we go through these questions, and if they are if they're satisfactory, if the questions are good, then we allow them to proceed. But we do one more thing, and that is we have the ability to suspend a transaction. So let's say a senior citizen, you know, passes that first protocol and they become a customer of RockaCoin. They come to the kiosk and they start to do a transaction. If they do a large transaction by our definition, we will suspend that transaction and not send the Bitcoin until we talk to them again. And we review the same types of things again to make sure that that customer is not being scammed, that customer understands what they're doing, and you know it is a legitimate transaction. Only then do we release the transaction. So I think that's a little bit different than maybe some other operators in the space that may just limit the customer themselves. We actually take another step, and I think it's an important one because we're able to, you know, capture, you know, someone that maybe just doesn't understand what they're doing. And then in that particular case, we don't send the Bitcoin. We refuse the transaction. We send them their money back. And again, that's something that we do. It's not really in any law, but it's something that we consider best practice, and it's really a way to effectively combat the you know, an elder abuse type scenario.
Secondly, do you guys do anything with non-fungible tokens?
No, we do not. Our kiosks sell cryptocurrency or buy cryptocurrency.
Now, I want to just actually printed out your entire book of testimony.
Sorry.
Yeah, quite lengthy, but I'm only going to touch on, oh, I don't know, 15 or 20 points.
Okay.
5. But we talk about the refund on a first transaction, and you made the commentary, I believe, that you could suspend a transaction. So if it was a first-time transaction, could that go into suspense for a period of time? So if the person wanted to get a refund and said, oh, darn, I really don't want to do this, it wouldn't have been processed. There would be a delay there, and then you could reverse it.
We have certain criteria that set that scenario up. I think it would be difficult and really disruptive to the regular customers if we did it across the board. But I am comfortable in the disruption or the interruption of that transaction, you know, given certain criteria that are met.
Now, in your written testimony, as a reference to the first time refund, you made a reference here, and it reads as follows, and this is verbatim. Such a refund, comma, unprecedented in the crypto space, creates a moral hazard. What in the world does that mean?
What I was trying to say there, and I apologize for not making it more clear, what I was trying to say was that, you know, in a situation where you have an asset that price fluctuates, if you have a scenario where an individual can sort of get a look at where the price goes and then decide whether or not they want to keep it, that creates a moral hazard there where the individual can take advantage of the kiosk operator. And even more so with the bill, the raised bill, the way it is stated, in that refund scenario is just a blanket, you know, first time transaction, you can request a refund. So, you know, my concern there and the moral hazard that I'm referring to is that ability to basically take advantage of the kiosk operator.
You know, it's kind of interesting when I think about transactions and purchases and things of that nature, and people can get refunds, and no one's ever referred to something that I brought back to Walmart or wherever as a moral hazard.
I understand your point there, but again, I guess I'll repeat slightly, and that is, in a typical refund transaction, the person brings that item back and then they get their money back. What is stated in this in the raised bill is not that. They don't have to bring the cryptocurrency back. So it's just like the Best Buy example I was using, where they buy something, they say they don't want it, I got to give them their money back, but they get to keep both, and that's not fair.
So is there a method where a person could return the crypto to you, and then you've completed a situation where there is no moral hazard there?
Yeah, absolutely. If we had a scenario where a first-time customer could say they don't want the cryptocurrency anymore, return the cryptocurrency back to us, and we give them their money back, I think that would be a workable solution, and it would be an actual refund scenario, as opposed to the thing that's in there currently.
So then there is the ability to create a refund scenario then?
Yeah. And again, it's incumbent upon the customer to return the item that they purchased from us back to us. I think that concept has to be clear.
In your written testimony, you make the comment, the law places prejudicial powers in the hands of the banking commissioner without kiosk operator protection or input.
Mm-hmm. That was I was making reference to the current bill on the books. And the current law on the books basically states that the banking commissioner can set a schedule of fees. And so therefore I was concerned about the fact that the banking commissioner, it could just say whatever they wanted. Now that is changed in the raised bill, where that section is taken out, and then also the last half of the refund is also.
I could go on for quite a while, but I think everyone should read your testimony carefully, because it points out some issues that both support you and basically don't support you, and issues that are supportive of the banking commissioner, and some issues that by your commentary are not supportive of the banking commissioner. I have to be perfectly honest with you. I have a lot of respect for the commissioner, and I have to state that I was taken aback when the comment was in there about the banking, too much power in the commissioner's hands. And we have a good commissioner here in the state of Connecticut, and we have a good banking committee that if there were to be something that was an overreach, the committee would act upon it with due haste. But I appreciate the comments.
Thank you, Rep. Rep. Foster.
Thank you, Mr. Chair. I appreciate the opportunity to learn in this public hearing. I'm a little remiss to admit that prior to this public hearing, I had educated myself on how blockchain works using a book called Blockchain for Babies that I read to my 8-month-old, and now I feel very competent. And so I'm happy to be here. I am joking, but I read your testimony. It was very interestingly set up compared to others, like a piece of legal, professionally submitted testimony. And I am sort of trying to synthesize what we've heard from a variety of different stakeholders over the course of the day. And as I'm reading some of the intention that was put forward by Detective Hogan, that he's hoping to generate sort of an information trail that could be used in police proceedings, that is in its sort of fundamental reality of what's necessary to protect senior citizens, pretty different from like what your website claims its goal is, which is to have like secure, anonymous transactions that are available for money that's not tracked. And blockchain in its nature is like a behind the scenes way of tracking transactions over the course of time. And so I am sort of stuck on some of the red text on page 17 of 22 of your testimony and suggestions. Item number 4, you specify, I think as a suggestion, that you could have owner operators use preemptive performance of blockchain analytics from an established third-party company specializing in such tasks to identify and prevent high-risk scored or sanctioned wallets from being used by a customer at the kiosk. So I'd like to sort of understand, is this a suggestion for your edit? Can you explain to me what you're hoping to accomplish here?
Sure, it's actually describing what we do currently. We have a third-party blockchain analytics provider, and when a customer comes to our kiosk and presents a wallet, we screen that wallet. We screen it with the third-party blockchain analytics provider. They assign a risk score to it, and we know if that wallet has been involved in sanctions activity or risky activity. And then we can make a determination from there and not allow that transaction to occur, not allow that wallet to be used. And that's really what I'm trying to describe there, although it got lost in translation a little bit.
No, I understand what you're saying. It's like a little
Okay.
Clearwater analytics kind of stuff happening. It's some interesting SB3 overlap happening.
Yeah,
from an AI perspective. So I guess I'm curious, one, like who are these third parties and what aggregate data are they using to determine risk? And how is the data that they use to determine risks made available to the police when they might be investigating a crime?
Sure. I've had conversations with the Connecticut State Police over the last several months too, and I've shared some of the stuff with them. They're very familiar with the platforms. There's basically 4 major platforms: CipherTrace, Chainalysis, Elliptic, and TRM Labs. Those are some, just to name a few. And what they have done is they have started to, through blockchain analytics, cluster addresses, associate addresses, name addresses. And what they can do is they can see, if you give them an address, they can see whether or not that has interacted with, criminal activity, suspicious activity, risk behavior, something like that. And they assign a risk score to it. We happen to use CipherTrace.
So I'm just trying to confer like my understanding onto this. So I am imagining that if you were the person who was soliciting money, there would be a criminal risk associated profile. But if this is the first time purchase of a senior citizen, then they wouldn't have a risk profile associated with their account, correct?
That would be correct.
Otherwise, you're going to discriminate against the elderly just because elderly are more likely to be made vulnerable, which would be problematic.
That is correct. A brand new wallet coming to us is going to have a low risk profile.
But how often are the victims of crimes like this, it being the first time that they ever engage with cryptocurrency?
I don't know how I would estimate that. What is the question?
My question is, if you think, so what I'm hearing today is like a likely vulnerable target for these cryptocurrency related schemes is the elderly.
Okay.
And they're targeted by people who know that they're likely to be vulnerable. And if those are the people who are most likely to be vulnerable at the kiosk, unless you're going to discriminate against the elderly and not allow them to engage in these transactions and use elderly as a risk profile, which I don't imagine you can do, how would you protect them? So you sort of said like the best protection is relationships.
Yes.
And sort of knowing what folks are, but you're not going to have a relationship with the likely vulnerable person because they're likely vulnerable the first time that they engage with you. So I guess I'm not really sure that I understand what your proposed alternative is and how it really offers protection, because it sounds like the aggregate proxy data that these companies are creating, which I joked about blockchain analytics, but I'm a research scientist, so proxy data is something I'm sort of familiar with. So the proxy data that I'm guessing that these aggregate scores are giving at best can predict the criminal component, but probably aren't likely predicting the at-risk population unless they're discriminating.
Well, I guess I don't look at it that way in terms of what it's actually doing. Remember that we are, in addition to running the wallet screens with the third-party blockchain analytics provider, we're also talking to that customer. An elderly customer of a certain age is spoken to at Rocket Point. We talk to them before we allow them to transact. And that is what I'm advocating, that conversation, because that is the most effective way to have that transfer of knowledge to where we can understand whether or not they understand what they're doing. Now, contrast this to a cryptocurrency kiosk where they just walk up and they just do it and they go away. That is the danger that you're describing. Whereas we're tackling the problem a little differently in that we are making sure we talk to that customer before they transact.
It sounds
So
like
we are the extra piece.
it sounds like you're establishing yourself in this public hearing as a good actor in the space and implying that without that personal interaction, that others are bad actors in the space. And I would just like to point out that fundamentally, I believe as a legislator, it's our responsibility to legislate for the bad actors. If we wouldn't have a job or any reason to exist, if everyone was good actors in the space, there would be no reason for us to write laws or do any of this work. So I've gone through a lot of your testimony and tried to sort of make meaning out of it compared to the things that we've heard. I mean, there's a lot to understand here and how best to legislate, but I do think it's concerning to me how prevalent these are becoming and the scale and magnitude of the threat that it offers to our community. And so what I would like, my last question for you, and then I'm sure I'll have other questions and I can send those via email later. But my last question is, how often are the very large transactions that would be flagged or prohibited under this legislation happening, and then there's no complaint afterward? So how often is that normal for there to be the exchange of 20K or more money, and there not to be some reason to believe that there's some malfeasance?
You're asking me how frequently a large transaction could occur that is not a fraudulent transaction?
Correct. I'm trying to understand what the normal business is like, transaction style and size.
Sure.
Of a cryptocurrency like this.
Two things. One, I'm not trying to dodge your question, but I'm sort of in the compliance department and I don't necessarily have access or tuned financial data, and I don't really think this is the forum in which for me to be talking about our company's financials. But I would say that there are a significant number of large transactions that are just totally fine. We do have this refusal program, and we will interrupt a transaction, and sometimes we refuse that transaction. And I will share with you that we refused about 50 transactions last month. And that doesn't mean those were large transactions. It could be any amount. It was a situation where the customer was put on hold, and we were like, hey, we have a conversation with them. We don't like what's going on, and we refuse the transaction, return the money to them.
So what percentage of your total business is that, the 50 transactions?
Again, I don't want to go into details, but I will share with you that we do a lot of transactions. So that is not a significant number.
Okay. It would help me to understand how necessary to your daily operations and how often without problem those sorts of transactions are happening, but maybe one of the other companies who are testifying can answer that question. But thank you for your time, and thank you, Mr. Chair. Sorry for taking that tangent.
Thank you, Representative. Okay, seeing no further questions, John, thank you for your time today.
Thank you. And also, if I could just return to one thing really quick. I was concerned that my comments were taken as a negative to the banking commissioner. It certainly was not what I was intending there. And I will say that I did meet with the Department of Banking in October in person in Connecticut, and I found them all to be very, very reasonable people. And I certainly don't hold any ill will towards the commissioner, nor do I anticipate him being a bad actor.
Thank you, sir. Next on our list is Mark Asnes, who is joining us on Zoom today.
Hi, good afternoon.
Mark. Hi.
Hey. Co-Chairman Doucette and members of the Banking Committee, thank you for the opportunity to speak with you today. My name is Mark Asmus. I'm a manufactured housing community owner here in Connecticut. I'm also the current president of the Connecticut Manufactured Housing Association. And I'm also a member of the Connecticut Manufactured Housing Advisory Council and was appointed by Governor Lamont. I had a chance to listen to a few of the comments, so I'm just going to go off script and hope I stay to my 3 minutes. But there's some impression that this bill is being created because I, as a community owner, have the ability to remove a tenant's home at will at the end of their lease. And just so we don't move off of this too far, I have no ability by law to, at the end of a tenant's lease that owns a home in my community, to remove that home. The only way I can remove a home is if I own the home, which means I would have to be awarded that home by the courts, and then I would have to record that home with the town, and then I'd have to file a removal certificate to be able to remove that home. So I have no ability to remove a tenant's home at the end of their lease as long as they're in good standing. So maybe that makes a lot of this all what I'm about to say moot, but I wanted to make sure that that was understood, that this is not an apartment, that I don't have the right to terminate someone's lease for lapse of time or because I want to. I cannot take someone's home and move it off the property as long as they're in good standing. So I do appreciate the banking committee's thoughtfulness in trying to offer a way to preserve financing for residents of manufactured housing communities. Unfortunately, this bill is not what's needed or appropriate. Initially, I believe there is a constitutional protection, by the way, against restraints on alienation, which means that a long-term lease eliminates the ability of a property owner to sell their property for another use. The issue today is not an issue of financing. There are plenty of mortgage lenders and have been for decades that specialize in financing for manufactured housing. The issue today is a lack of housing. There are only 10,000 lots in the state of Connecticut, and we only make up less than 1% of all housing. The issue is, how do we create more housing where we can have an opportunity to have an open conversation about financing? The reason that local banks got out of financing for manufactured home is because the delinquency rate was very high, and the local banks and credit unions thought the risk wasn't worth it. Keep in mind, there's no securing a home because there's no land component. So the bank can't attach the land, and that was part of the problem. But again, there are plenty of lenders that offer financing for mobile homes. However, they offer them at a higher interest rate. The banks don't need a long-term lease. In this case, what's being proposed could be up to 40 years, which is 10 years past the end of a term, which just isn't possible for me to offer. The Department of Consumer Protection, which governs manufactured housing, mandates that I offer one-year leases with auto renewals. So if a community resident is in good standing, that resident could live in the community in perpetuity. I cannot offer by law a person with a different lease than the person next to them as long as they have the same size lot. So my lot rents need to be the same for everybody. My lease terms need to be the same for everybody. So just because someone's being financed, I can't offer them a 40-year lease and then not offer it to everybody else that lives in the community. I am required by law to offer the same lease term. There is no way to remove a resident at the end of their lease, and it's unbelievably difficult to remove a home unless I have ownership. The bill as proposed is trying to fix a problem that doesn't exist. As I mentioned to Representative Doucette in a recent roundtable that he invited me to, if the state of Connecticut wanted to guarantee loans for local banks, and we introduced those banks to what a new manufactured home is like, you could probably restart their interest. But I don't know if the banking committee is aware, but the CHFA has already put together a program that already fixes what this bill is trying to accomplish. So they already offer residents through financing through a list of 70 local banks and mortgage lenders, and none of them require a long-term lease today. It doesn't apply. So the program already exists. The state has already addressed it, and the CHFA is already doing mortgages with residents in mobile manufactured homes. The best course of action.
Thank you. That your 3 minutes.
I did. All right. I almost made it.
Has elapsed. You almost made it. No, thank you. Appreciate you joining us today. Any questions from Mark at this time? Seeing none. Thank you, Mark.
You're welcome.
Next on the list is Rafi Podolsky. Afternoon, Rafi.
Good afternoon. Thank you, Mr. Chairman, members of the committee. My name is Rachel Podolsky. I'm a lawyer with Connecticut Legal Services. There are two bills that I want to speak to. The first one is House Bill number 5345, where you just heard a speaker. I want to say, I hope he's still listening, that I support everything that he said. The problem is to a large extent resolved by CHFA's program. But it's not resolved in the sense that I think private lenders continue to charge a higher interest rate when they do lend. And one of the goals is to get the interest rate the same. I just looked up CHFA's loan prices, and they seem to be the same for mobile homes as for stick-built homes. And so that's really what the goal is. But I think that the bill doesn't work because the long-term lease is not it's just the wrong solution. The solution is through the banking industry, and maybe it's happening enough now. The second bill I wanted to speak to is Senate Bill number 284, which is the Security Deposit Loan Assistance Program. My feeling is this is something that probably needs a real study. The bill is very detailed, and I think there are a lot of problems with the details. The underlying problem is very real, which is it's very hard for everybody to be able to afford security deposits, especially as the rents go up and the deposits get higher. So the idea of looking for a solution is a very good idea. If you look at the bill closely, it seems to me the bill's trying to do everything and at the same time not doing all the stuff that's needed. For example, the tone of the bill is to help people who are low income, which makes sense. And it talks about Medicaid eligibility as being one way of identifying people like that. But at the same time, it says that to get a loan, you need your rent to be less than 35% of income, which will cut out most of that demographic. It leaves, if you're dealing with people who don't have the money for security deposits, some of them, a subgroup at least, will have a hard time paying the rent. And that generates a whole new set of consumer protection issues. We learned in some other contexts where you can, in some cases, buy rental insurance, buy security deposit insurance. The consumers would misunderstand it to think they were paying monthly on an installment basis for a security deposit, but they weren't. They were actually paying for insurance that they wouldn't damage the property. And so when they took good care of the property and left, they discovered they didn't get their payments back because it wasn't actually a security deposit they were paying. That was really a disclosure issue in a sort of false assumptions by the renters as to what the product was. Those things, though, are solvable. It's not like you can't solve those problems. So my suggestion is, if the committee wants to pursue this, I would suggest that whether you do it by statute or just by doing it, pull people together. We certainly are perfectly willing to be involved and try and see if there's something that really will work. It's an inherent problem because the bank isn't giving the money away. It's not a grant program. It's a loan program. They want to be paid back. And the terms of this bill, for example, limit the amount of the security deposit that they're going to cover, which means the renter has to have other sources of money. And so it's hard to make this into a working program, but not necessarily impossible. And it's certainly directed at where there's a genuine need. So thank you. That's really all I have to say on these two bills.
Thank you, Rafi. Appreciate your testimony on those. On the mobile home bill, I understand you've done a lot of work even recently in the last session regarding a lot of different issues in the mobile home area. I guess I would just say that and to the last speaker as well, the CHFA program, which we're well aware of, I think has had, we understand, pretty low utilization. One reason for that being the underwriting requirements and the down payment on that. It's a conventional loan, as I understand it, so you got to be able to put 20% down, which not everybody is able to do, whereas an FHA loan is available for mobile home financing, but that requires the 40-year lease or the lease to be concurrent with the term of the mortgage. So that's where that concept came from. But you know, I guess I do, you know, appreciate now that we've seen sort of from both angles that folks are a little hesitant to go into the long-term lease. If it was clear that that lease could be freely terminated or assigned by the tenant, would that be better from your perspective?
I suppose it would, there's, well, let me put it this way. First of all, in terms of kind of the federal secondary market, that has been an issue for literally decades, that you can't sell something on the secondary market unless you hook it to a lease of a certain, I think 30 years is the federal minimum. And at some point, there was active consideration at the federal level of recognizing that a mobile home park lease is a lease for 30 years or more, even though it's a one-year lease. And that comes out of what Mark Asmus said, that under the statute, he has to renew your lease subject to your complying with all the terms. And he has to allow you to sell the house to somebody else on site, again, assuming you comply with certain basic things, so that you that degree of security, that's to say, if you don't break the rules, it keeps on going, is, you know, if you break the rules on a 30-year mortgage, you can lose your house because you're not complying with the rules. But, and there was one point I thought the feds were actually going to accept that as part of their own rules, and that was going to solve the secondary mortgage problem. Otherwise, what was happening was the banks had to keep the paper and they couldn't sell it. And I guess I've lost track of whether that, to what extent, I'll take your word for it, that remains a problem at the federal level. Anything we could do to break into that would be helpful. In terms of, I think a longer term lease is a problem for the tenant as well as for the park owner. They already have the right to sell. A lender who's financing, if they foreclose on whatever the financing is, already has a right, essentially, they become the resident. And therefore, the lender itself picks up all the rights of the resident. That's the right to the house, it has the right to stay, it has the right to sell the unit to somebody else. So those sort of things are sort of in place, I think, under the existing statute. The problem for a renter becomes, and the statute, by the way, requires the lease be at least a year. It doesn't preclude a longer lease with the tenant. So if, the issue of whether all the leases have to be the same, I don't have the statute in front of me. But basically, the statute says they have to be the same for people in the same circumstances. It does. So, for example, if somebody's got a big lot and somebody's got a small lot, you don't have to charge them the same rent. I haven't really thought about to what extent a different lease, you could do a different lease term. If you want to do a 5-year lease, does everybody have to get the 5-year lease, or could some people have a 5-year and some a 1-year? I sort of thought you could do that with the different, but I could be wrong about that. And I hadn't really thought that one through before. But I think there's a discomfort for renters. And especially, it goes to things like, well, what do you do about rent increases then? On day one, when you sign, say, a 5-year lease or a 30-year lease, are you putting into place a rent escalator clause that you're not going to be able to control? I think from the park owner's perspective, they're a little bit nervous about predicting the future. And I would say from a resident's perspective, they're also pretty nervous about the future. So, you know, you don't see escalator clauses in residential leases. You see them in commercial leases because that's just the way business is done. So I sort of have the feeling that renters in general would feel very uncomfortable. And you have a lot of older people in mobile home parks who probably are not confident how long they're going to live. And, you know, without really feeling comfortable is what it's going to mean if, you know, if I've still got 7 years left on my lease and I die, what's that going to mean to my estate and to my children? And it's not that you can't, it seems to me, it's that I don't think the product would sell that well, frankly. from either the park owner or the park resident angle.
Okay.
There have been, I do believe, that some of the Jensen parks in Connecticut used to have at least some. I know that before those parks have all been sold now, but I believe there was actually discussion about longer term leases, but I don't think it ever came to fruition.
Any other questions? Anyone? Seeing none.
Thank you very much.
Thank you. Okay, we are moving on and we have Michael Alberts next. Welcome back to the LOB, Representative Alberts. And
Thank you,
for-
Mr.
Thank you for
Chairman.
your patience.
No, thank you. It's good spending the afternoon with you. Good afternoon, Chairman Doucette, Ranking Member Delnicki, Vice Chair Santos. I am Mike Alberts. I am President and CEO of Jewett City Savings Bank. We are approximately $420 million by assets bank. We have 7 branches, 90 employees. We're mutually owned. We're based in Eastern Connecticut. I do thank you for raising the concept of adjusting the requirements for the Banking Commissioner's approval of bank branch improvements, and that's contained in Senate Bill 282. At present, banks like ours must obtain the approval of the Department of Banking Commissioner prior to embarking on branch improvement projects with a cost that exceeds $750,000 or 5% of the bank's capital level, whichever is lower. The figure has not been adjusted in many years. It does create a regulatory burden for banks like ours that I believe is unnecessary, particularly for well-capitalized organizations like Jewett City Savings Bank. For the record, our Tier 1 capital level is just under $60 million. We are under no open enforcement actions, formal or otherwise, by the Banking Commissioner or the FDIC. We did submit a very comprehensive application package last year to the Department of Banking for consideration. It was approved, but that $1.3 million application took about 40 man hours. And in an organization as small as ours, that's significant. When you consider that federally chartered banks have no such branch improvement application requirement, it does put us at a disadvantage. So the language contained in Senate Bill 282 that's before you would create that exclusion from a branch improvement application to the Department of Banking for adequately capitalized, well-managed state chartered banks. It would be very well received by Jewett City Savings Bank and other community banks across the state. I do thank you for raising this issue for consideration. I do appreciate the work of the Banking Commissioner and the Connecticut Bankers Association as well. I think this is a good resolution to a challenge that will help streamline the regulatory burden for us. That application that we submitted took about 2 months to go through. So it was a lot of work on our part. There was some give and take between the banking department. As I said, it was approved, but it represented a burden that I'd rather not have to deal with in the future. So, and again, we are a small bank. We are 7 branches, but we're doing a lot of good things, I think, to improve customer service with these improvements and bringing banking into the 21st century. But it is, it would be much easier and more efficient if we didn't have this language that was kind of bogging us down a bit. So with that, I'd be happy to answer any questions that you have of me.
Thank you, Mike. And thanks for really bringing this issue to our attention. I, like I'm sure you do, sleep with Title 36A under my pillow every night, but I was not aware that this was a requirement. And I do agree with you that it's something that we ought to streamline, especially considering that it's not a requirement for everybody out there. Again, thank you for bringing this forward. Any questions for Mike? Anyone? No? Oh, Rep. Delnicki.
Just a brief comment. Hopefully this levels the playing field a little bit for you on a situation like that. But I do have to ask, from beginning the process to ending the process, how much did the cost of the project go up?
It didn't. We had a budget. We built in a contingency as well.
Okay.
And that $1.3 million included not only the actual physical improvements, but it also included equipment. So we came in under budget. As a small bank, we gotta make sure we do that.
Yeah, that goes without saying. Thank you. Thank you, Mr. Chair.
Thanks, Rep. Delnicki. And thank you, Mike. Thanks again for your patience and hanging out with us today.
Thank you, Mr. Chairman. And as I think Senator Duff said earlier, I think he mentioned something about PTSD for being back in a familiar room. And I think this is the first time that I've testified before banks. I've always been on the other side where you sit right now. So, but I appreciate the opportunity. Thank you.
Well, we enjoy having you. Don't be a stranger.
You bet.
All right. I think we're on to our last person on the list today, who's Mark Smalley and who is online. There's Mark. Welcome, Mark.
Thank you. Members of the Banking Committee, I am Mark Smalley, the Chief Compliance Officer at Bitcoin Depot, the largest Bitcoin ATM kiosk operator in the world. Thank you for your time and affording me the opportunity to speak about our perspective on HB 5211. Likewise, I was pleased to meet with Detective Hogan several weeks ago to provide input about compliance and fraud prevention in the industry. Our business model is that we place our kiosks in retailers such as gas stations and convenience stores, renting that space, many of whom are small businesses. A customer inserts cash into the kiosk and almost instantly purchases Bitcoin and then transfers the Bitcoin to the customer's designated wallet. We do not custody customer funds or have accounts where customers can hold funds. It is purely transactional in nature. We pay the store owners monthly rental fees. We pay armored companies to service the kiosk, and we pay taxes in the state of Connecticut. Our kiosks are placed in a wide variety of neighborhoods in Connecticut, including higher income areas and not targeting marginalized individual in lower income areas, as anecdotes may suggest. Our customers include the underbanked and unbanked. Individuals who have used our services have self-designated that the primary purpose of purchasing Bitcoin is sending funds to family members abroad, online payments and purchases, remittance and money transfers, and investment or store of value. Our concerns with the Connecticut legislation include the following 4 items. Did clarification on winding down operations language to address abandoned property or escheatments. The 72-hour refund period does not align with the transactional nature of our service. And the next 2 items, which I will discuss more fully, transaction limits and fee caps. Placing permanent or long-term transaction limits have unintended consequences, including skirting federal reporting requirements, like the monetary instrument log, funds travel rule, currency transaction reporting, which translates previous routine reporting into obfuscation. They encourage both good and bad actors to spread transactions across multiple kiosk operators. For bad actors, these limits obscure criminal activity from law enforcement by impacting pertinent reporting already mentioned, and also SARS. And good actors choosing to use alternate banking methods should not suffer additional taxation in the form of kiosks shopping to multiple locations to complete necessary transactions. Operating a cryptocurrency kiosk has unique costs, including purchasing, installing, maintaining the kiosk equipment. There are also recurring costs, including rent to small businesses hosting a kiosk, insurance, legal bank fees, blockchain access fees, cash management, armored vehicles, monitoring and surveillance, BSA AML OFAC compliance, cybersecurity, fraud detection, and live customer support. Exchanges that custody funds do not have the hardware costs that kiosk operators maintain. Other financial services companies that custody funds can assess fees in multiple touch points during the relationship, whereas we cannot. Bad kiosk operators who may charge lower fees do not maintain strong compliance and consumer safeguards. The current proposed fee cap of 10% is the lowest in the country. Connecticut must balance its desire to have the most reputable BTM operators in the state with higher costs of compliance and consumer protection. We are also working in California on cleanup legislation there. We have found that most operators were not complying with the legislation by conducting our own testing. The banking department in California does not have the resources for investigation and enforcement. They have told us that. As non-operators are thriving there, our company cannot sustain operations there and have removed or will remove approximately 25% of our kiosks by the end of first quarter. We agree with Detective Hogan about the dangers of non-compliant operators expanding into Connecticut. Please help us work with you so we can stay in business in Connecticut. I'll take any questions.
Thanks, Mark. Appreciate it. Rep. Delnicky.
Thank you, Mr. Chair. I'm going to ask you the same two questions I've asked the other folks that represented Bitcoin purveyors. First off, what sort of protections do you have for seniors on buying the product?
Well, yes, for seniors and any customers, we offer live customer support. We have a number of scam warnings that are located physically on our kiosk, on our screens, sent through text messaging. I've included examples of those on my testimony submission. We also employ technology in a number of ways. So we have employed wallet association, where if one account is associated to a wallet, no other account can use that wallet. We've also added in a layer of geographic association to accounts so that we can prevent transactions if the account is used over 100 miles from the original kiosk. We employ blockchain analytics. We have transaction monitoring software. We also work with law enforcement. So we have a law enforcement relations team that has been conducting educational sessions with law enforcement, and we respond to any subpoenas within a week, typically.
Have you ever worked with Connecticut State Police?
We met with Detective Hogan a few weeks ago. We've also been on site to visit with the Department of Banking.
And lastly, do you do anything with non-fungible tokens?
No, at this point in time, we only will sell Bitcoin for cash.
All right. Thank you for your testimony and your answers. Thank you, Mr. Chair.
Okay. Any other questions for Mark? Seeing none. Thank you, Mark, for your time.
Thank you.
Okay. And with that, I don't see any other names on my list, so I will call this public hearing to a close. Thanks, everyone.